Thank you. As always, looking ahead to payrolls, 8:30 Eastern, the median estimate 320,000, Deutsche Bank at 325, the highs from SocGen at 440, Goldman at the lows at about 225. Lisa, this email just came in from a viewer. Thank you, Peter. Just weeks ago, we're all mad when CEOs said nothing, and then the earnings surprise. Musk speaks up, and we're supposed to question it. What say you?
I would say, is he giving us some sort of earnings revision? Because it doesn't sound like it. He's giving us a comment that was sent out to others at the company in an email, as reported by Reuters, saying maybe, just maybe, this super bad feeling will lead to a 10% job cut. Look, it's great to have communication, but it seems like this is actually muddying the waters more than it's really adding light.
TK?
I think unemployment rate's critical here. I mean, they're praying for level unemployment rate, or they would kill for a tick up in unemployment to calm the waters and set up their story past ECB to that Fed meeting, whether they get or not. Clearly, survey says they won't get that.
You talking about the Fed or Tesla?
I'm talking about the Fed.
Okay.
You know, Elon, come on. John,
hard.
I wore my Jubilee tie today for you. John, this is the tie I would wear to the Epsom Derby. You say Derby, John, tomorrow?
Oh, Tom, I love you. Futures down a third.
It's my Jubilee tie.
Good.
On radio, it looks great.
The Nasdaq 100 down about 0.6%.
Right, cheerful.
You were not following the conversation when Lisa and I at all, were you?
No, I wasn't. I'm worried about the
I know you weren't.
Megan just entered St. Paul. What do you want?
John's speaking. It must be about the Fed. So this is what I think about the Fed. From New York City, this is Bloomberg.
It's Friday.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Tesla CEO Elon Musk reportedly has told executives the electric car maker needs to cut staff by about 10%. According to Reuters, Musk sent out an email titled "Pause all hiring worldwide." The report says that Musk wrote that he had a, quote, super bad feeling about the economy. A 10% cut at Tesla could mean a loss of almost 10,000 jobs. President Biden is pleading with Congress to toughen gun laws following a number of mass killings. In an evening address from the White House, the president called for a ban on assault weapons and high-capacity magazines. He acknowledged that lawmakers are unlikely to ban the weapons, so the president called for raising the age to buy them from 18 to 21. According to the UK's Defence Ministry, Russian forces now hold the initiative in Ukraine 100 days since Vladimir Putin launched the invasion. British officials say the Russians have gained momentum in their push to capture the Donbass region. They said the original Russian plan failed, but Moscow has since changed its goals and is now focused on the Donbass. And the price of oil is headed for a sixth straight weekly advance. A highly anticipated OPEC Plus meeting delivered only a modest increase in production that failed to ease concerns over a widening supply deficit. There was speculation the Saudis were preparing to pump significantly more as part of a reset of relations with the U.S. And Bloomberg's learned that a fat finger trade may cost Citigroup at least $15 million, and the final figure could be higher. The blunder caused a flash crash in European stocks last month. A trader in Citi's trading unit in London incorrectly added an extra zero to a trade early in European market hours. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
If by September, the September FOMC meeting, the monthly readings on inflation provide compelling evidence, then inflation is moving down, then the pace of rate increases could slow. But if inflation has failed to moderate, then a faster pace of rate increases could be necessary.
Have you got that? They just don't know. Loretta Mester, the Cleveland Fed president, echoing what we've heard from so many Fed officials over the past week. From New York City this morning, good morning. Futures negative on the S&P, on the NASDAQ too. We're down 0.4% on the S&P, on the NASDAQ 100 down 0.7%. Yields higher on the week, higher on the day. On the session, up a basis point on a 10-year to 291.68. And I have to say, look out the bond market. German 10-year yields, Tom, are climbing again by 3 basis points. I think the high of the session pushing 128. We're up 30 basis points on the week. 30 basis points on the week.
First thing I looked at, John, when I came in today, the one anomaly on the Bloomberg Launchpad is euro-yen. You've got relative euro strength is seen by the German bunds, and euro-yen really is out to a resistance level of strong euro, weaker yen, with a yen near 130. I think it's of note into the decisions of the ECB on strong euro.
We are making new highs. New multi-year highs in the bond market daily on a 10-year bund yield. Tom, June 9th for the ECB next Thursday.
Now, June 9th may be the date for Christine Lagarde, but the date here for all of Ukraine and, frankly, Russia is it is 100 days. Emily Wilkins in Washington and Maria Tadeo, who has done a phenomenal job for us traipsing Europe in these first 100 days of war. Maria, to cut to the chase, given our time frame, what do the next 100 days look like for Ukraine? What do the next 100 days look like for Mr. Putin?
Yeah, and Tom, it's very hard to tell because the nature of this war has turned out to be unpredictable. If you look at the first week of the war, the Ukrainians were very successful at repelling the Russians. They have been successful until now, but the narrative and the momentum in this war over the past week has really shifted, and it's shifted in Russia's favor. If you look at President Zelensky yesterday, he updated some of the numbers and said, when you look at the Ukrainian map, Russians now control 20% of Ukraine's territory. It's not just the 20%, is the geography and the nature of those territories. They control access to the sea. They also control industrial hubs on the east. So for Ukraine, this is now a war that's changing in nature, but it's not necessarily in their favor. But Tom, I would point to the words of the NATO Secretary General saying, at this point, the longer it goes on, the more unpredictable it will become in nature.
So right now, Maria, when you take a look at the impact of this war, a lot of people are looking at record high inflation reads throughout Europe. How much has that changed sentiment in terms of the approach that people would like to see from European governments?
Yeah, and that is a big question in Europe. And I've put this question repeatedly to every leader that I came across on Monday, Tuesday, from the Baltics to the French president, to the Belgian president. And to me, what is difficult is that right now, when you ask them, what does victory mean? They don't give you a clear answer. When you ask them, what is the threshold, the pain that you're willing to tolerate, they're not willing to give you a number. I was surprised, very surprised, by the way, by the Belgian prime minister, who told me, we've done a lot. It is time to take a breather. If you put that question to a Polish or someone from Latvia, they'll tell you we haven't done enough. We need to be tougher. So I think that is really the issue for Europe going forward. How much tolerate, how much pain they're willing to take, but also what does victory mean? And to me, it's not clear at all what the consensus is at this point.
Emily, this really bleeds over into the U.S. picture right now. We're going to hear the messaging after the 8:30 a.m. Eastern jobs report. How much is a good report good news for the president versus a sign that, frankly, inflation is going to be the main issue going forward and is not necessarily going to abate all that quickly?
I mean, right now, the Biden administration has really heavily relied on these jobs reports to make the case to the American people that they are doing what they need to do with the economy. They'll say, yes, inflation's bad, but hey, look, we've got jobs under control. We've got unemployment really low. Isn't this great? But you did see Biden do a bit of an expectation reset in an op-ed earlier this week in the Wall Street Journal, saying that, it could actually be a positive thing for the economy if we don't see these record-busting job numbers like we have in some of the previous months. He made the argument that it shows that we're successfully moving on to the next stage of recovery, and just kind of sort of setting re-expectations here on exactly what these numbers are going to mean and what success is now going to look like for the White House.
Emily, in the heat of domestic politics, and given the next 100 days for Ukraine, has Congress moved on?
Well, yes and no. I mean, remember, Congress did approve $40 billion for the White House to spend how they feel they need to in Ukraine. And that is a real signal that the White House request and what Congress allocated is that lawmakers in Washington are preparing for a very long battle here. They wanted to give Biden the resources so that he's not going to have to come back to them every couple of weeks asking for additional funding. So I think for now, at least in terms of Congress, the focus has shifted to other measures such as gun violence. I think for the White House, this is still something they are very much focused on. You saw Biden's other op-ed this week, of course, talking about sending longer range missiles, different types of artillery and weapons to Ukraine. So it shows that something's that's still on the White House's plate, but this is one of numerous issues. And I think there's also a really big question, Tom, about what happens if and when the White House needs to come back to Congress for additional funding. You start to see some concerns raised by Republicans. Now you're seeing some from Democrats saying, hey, we want to support Ukraine, but we need some oversight on exactly where all this money we're giving you is going. And I think that's going to be a question that the Biden administration is really going to need to answer before they come back and ask Congress for additional funds.
Emily Wilkins, thank you. Maria Tadeo, to you as well. TK, a lot has happened this week in Washington. Some of the reports around the president meeting with the Crown Prince Mohammed bin Salman, trying to do something on energy. OPEC made a move. Tom, OPEC made a move, and what difference did it make? Not a big one.
Not a big one. Yeah, this is really important, John. The asymmetry here, and you've just got to believe that if the president visits Riyadh, you're going to see a return visit to Washington by the royal family of Saudi Arabia. I'm not sure who's going to show up, but you've got to believe there's a symmetry being established here.
Tom, I wanted to bring up the Goldman research too, because they're really nailing the point that you've been making on China when it comes to the commodity market for the last few weeks.
Yep, Jeff Curry.
This is what the team said. We believe this ramp up, OPEC, remains insufficient to balance the global oil market, which is already shifting back into a deficit following China's demand recovery. We reiterate our second half 125 Brent price forecast. 125 for them, Tom.
And I think, John, the people watching and listening feel the same way, just anecdotally, viscerally, this summer of America is one of demand is still there. And then you overlay on, I'm sorry, I believe, John, China's opening up.
A feature of the conversation we've had repeatedly, Bramo, demand destruction. Just keeps coming up, doesn't it? Keeps coming up.
And frankly, the fact that we got from OPEC Plus no recognition of the fact that a number of their participants are not producing, are not meeting their targets. And actually, yes, they increased their targets, but they also increased them for example, Russia and other nations that aren't meeting those targets that are actually cutting. So how much does this actually add to a market? How much of a recognition is this? How much does this do to really balance that supply-demand imbalance?
2 hours away from a payrolls report, 320,000 is the median estimate. Looking for a little bit of deceleration here. The previous number, 428. Futures lower. We're down 1/3 from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
From New York York City this morning. Good morning to you all on this Payrolls Friday. This market has faced down a lot this week. The core of the Fed, Governor Waller, Vice Chair Brainerd, pushing back against this idea of a September pause. We had a warning from Microsoft on FX headwinds and Tesla, according to Reuters, warning on jobs as well. Maybe job cuts coming to Tesla, yet still on the week, just about positive coming into Friday. Futures this morning down 1/3% on the S&P. On the Nasdaq 100 down 0.6%. Next stop for this market, payrolls, about 2 hours away. 320K is the estimate. And going into it, this is what the bond market looks like. 2s, 10s and 30s. Your 10-year yield higher on the day, higher on the week by about 17 or 18 basis points, not just stateside, but also on the other side of the Atlantic. The German 10-year Bund yield up 30 basis points on the week. 10s in America right now, 291.68. That's how the Treasury market is set up. This is what the commodity market looks like. For the likes of Goldman and Jeff Curry, they are not interested in what OPEC Plus did yesterday. It is insufficient with China demand coming back online. And Tom, they still look for 125 on Brent. Brent right now on the year up by 76%. Yeah. Right now, 116.78.
On 117, John, I'm going to look at 120 as a real emotional level for the people listening and watching. We visited that, but to really break through 120 and sustain above 120 would be a game changer.
119.98, I think, the high of the week on WTI, Tom.
My word.
115.91.
Powers of concentration.
Is where we are right now. Thank you, Tom.
That's very good.
Thank you very much.
Are you done with your...
I am finished. You may pick up and go to our guest.
Julia Coronado often visits on Jobs Day, of course, with prodigious economic skills and macro policy perspectives. Julia, let's go back to the wooden plank we call a teeter-totter years ago, and you've got a teeter-totter between goods and services, the up and down, the dynamics there, jobs report to jobs report. How will goods and services teeter-totter this morning at 8:30?
So there's a little bit of an irony that we expect in the pattern of job gains. We expect the goods producing sectors to remain pretty red hot on the hiring front. There's still too much catching up that they have to do in terms of manufacturing and in terms of construction, even though housing demand is starting to weaken and certainly consumers are shifting away from goods. There's still plenty of rehiring and hiring back up that the goods producing sector has to do. Meanwhile, the delivery of goods and the selling of goods is where we expect some weakness. So we expect some moderation in retail hiring and warehousing. We've heard that in earnings reports. And of course, leisure and hospitality has been moderating in terms of hiring. That's mostly a reflection. Consumers are still going out and traveling in full force right now. It's just that they've now largely completed that rehiring plan and don't need to keep rehiring at this soaring above trend pace. So that's where we expect the biggest slowdown is actually in the service sector, despite the fact that consumers are shifting their spending back to services.
Julia, I want you to go back to your claim at BNP Paribas where you absolutely nailed the slowdown in the American economy. And let me just ask, dumb question 101 for the day. Are you able to see a recession coming?
I mean, look, the odds of a recession have certainly risen, especially on the back of the war in Ukraine. The kind of, you guys have been discussing oil prices. That is a pure hit to consumer purchasing power. Typically in the last cycle with the American shale revolution, we'd seen an offset from increased drilling activity and jobs. And so the energy belt would do really well when energy prices were high, even though it taxed consumers more broadly. We're seeing less of that because of some of the ESG and the shift away of capital from these companies. We're seeing less of the drilling response that we have seen in the prior decade, and therefore higher prices and less stimulative activity means more of a hit to the American economy. That said, I think the contrast between now and last cycle, when the U.S. economy just was so vulnerable and kept being knocked back by any shock, internal or external, that reflected consumers that were in this steady deleveraging. And really, consumers have not taken on that much debt. There's been a little bit of a pickup in some credit card borrowing, but consumers didn't power this particular housing boom. That was more speculative investing, cash buyers. Household debt actually looks pretty reasonable, and consumers have been pretty cautious and are still fairly cash rich. So there's a bit more resiliency, I think, in terms of underpinning the U.S. consumer to weather some of this stress. Of course, it is stress, and some consumers are going to feel it more than others, and it's definitely a risk. That said, I think we've got a shot at weathering this, and some of it will depend on how all of these inflationary forces play out. Do we start to see some of these supply chain issues provide some relief for things like cars and other goods that are being shipped, or does the Fed have to really just put the pedal to the metal and take us into restrictive territory?
Julia, if Larry Fink of BlackRock is correct, and that supply chain disruptions are going to continue for the next couple of years, they're not going to abate, and they're going to create real pressure on the inflationary front, then can we avoid a hard landing?
So when we talk about supply chain pressures, I think it's certainly clear we've entered a new world of frictions that isn't going to abate. We need to think about levels versus changes, though. If inflation is continuous price increases, so are shipping costs going to be continuously increasing, or have we just shifted to a world where goods are now more expensive? We don't expect goods to become less expensive or shipping prices to go back down to where they were, but do they just stay high and stop rising further? That's one of the questions. So I think for me, I think more in terms of, yes, I agree that goods are going to stay more expensive. That said, do we see some improvement at the margins that just sort of level off those price increases? That means inflation on goods goes back down. And we've actually seen that in a number of key goods categories. Used cars have stopped inflating. Televisions, computers, home electronics have actually returned to their normal disinflationary pattern, despite the fact that we import those things and shipping costs are high.
Julia,
so I think it's more of a relative price shift.
You're making a strong argument for a soft landing. We have had guest after guest come on the show and say that the Fed's projections of a soft landing, of how we get there, of an unemployment rate that doesn't rise much beyond 4%, as Diane Swank said, fantasy land. Others say a lot are fanciful. Basically, other people coming out and having similar things to say. Why do you think that this is realistic?
Look, because we have an economy that has been hit by some extraordinary shocks. And we've given that economy a tremendous amount of resources to absorb that blow. And we are seeing companies sort of be resilient, some better than others. We are not, in this earnings season, we're starting to see more winners and losers. But companies are, look, they're paid to make money and stay profitable and sell goods and services. And they're working really hard to adapt to these shocks. So I think that's the reason, that's the avenue where we can see a soft landing, is that we did not come into this shock period laden with a lot of imbalances. Consumers, again, are in good shape. They were very cautious and sensible going into this, so their balance sheets look really good and healthy. Loan delinquencies remain near all-time lows. These are things we did not have in the last recovery. So, again, we've got this strong foundation. Yes, the shocks are coming at us one after another, but we've got a pretty good foundation, a low unemployment rate, lots of jobs and strong household balance sheets, low loan delinquencies, high credit quality. So yeah, it's gonna hurt. And I'm not saying by any means that a soft landing is a foregone conclusion, because it's not. It's a very uncertain territory. But what you just highlighted, there's a very wide range of views, and all of them are perfectly reasonable. There is so much uncertainty. But, there's sort of the doom loop of tracing those shocks through. And then there's, we got to remember, the economy tends to be more resilient than we give it credit for. Consumers, businesses tend to adapt and adjust to these conditions. So I just see a pretty decent shot at a soft landing rather than a recession being a foregone conclusion.
Julia, thank you for your thoughts. Julia Coronado there of Macro Policy Perspectives. And just listening to Julia go through things point by point about how resilient this economy might be, the data points. Tom, it's unbelievable to think that we've got 1.9 jobs for every unemployed person, according to the data this week, that we could have unemployment down at 3.5%. Yet every time we get that UMich Consumer Sentiment Survey, it's at decade lows. The disconnect between what the economists tell us this economy is doing, what it looks like, and how consumers tell us how they feel, has it ever been this wide, Tom?
I go the uneven distribution, and you look at deciles, 10% of the public, John, spread out across 100%, 10 deciles, and it's hugely uneven right now, which I think Dr. Coronado alluded to. She was really talking the book there, John, of the Fed and the hope, if you will, of the Fed. And she made clear many things could upset the apple cart on the way to some form of neutrality. Do we know where that is? I don't think so.
And Kathy Jones at Charles Schwab yesterday, Lisa, I think put it well. It's an aspiration. It's not a forecast.
Yeah, that was really good. Yeah.
A lot of people would agree. I think Joe Livornia of Natixis put out a note where he said a lot of these indicators that we're looking at that show strength are lagging. The forward-looking indicators, like sentiment, are starting to show that pain. At what point does it catch up?
Futures down 0.4% on the S&P. Yields higher by around about a basis point, 291.68. Your jobs report coming up in about an hour and 50 minutes time. 320K is your median estimate in our survey. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Today's U.S. unemployment report is likely to show the smallest gain in jobs since April of 2021. The median estimate in the Bloomberg survey says 320,000 jobs were added in May. Meanwhile, the report also may show a downshift in average hourly earnings growth. Meanwhile, a report from Reuters says that Elon Musk wants to pause hiring at Tesla and cut almost 10,000 jobs. Musk emailed that he has a super bad feeling about the economy. BlackRock CEO Larry Fink expects inflation to remain elevated for several years. Fink told Bloomberg Television the primary reason is snarled global supply chains. He said the Fed doesn't have the tools on its own to fix the supply problems. And in Turkey, annual inflation soared past 73% in May. That's the highest going back to 1998. Consumers saw food and energy prices jump, whilst ultra-loose monetary policy contributed to the weakness in the lira. Turkish inflation has been in double digits for much of the past 5 years. Authorities have prioritized economic growth and exports. Kim Jong-un has congratulated Queen Elizabeth II on the 70th anniversary of her ascension to the throne. It was the North Korean leader's first public message to the monarch. Last year, the Queen sent Kim a congratulatory note for a National Day celebration. And Bloomberg's learned that Apple will improve working conditions at its retail stores in response to efforts to unionize. The company has agreed to make hours more flexible in the coming months, and employees won't be forced to work more than 5 days in a row. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
China's coming out of lockdowns right now, and they're stimulating. Then we throw on top of that a very strong travel season. People haven't gone on holiday for 2.5 years. You can already see it in plane bookings and bookings throughout. You put it all together, this market's going to get significantly tighter as we look out towards the summer months.
And Goldman and the team, that was Jeff Carey looking for 125 on Brent. From New York City this morning on this Payrolls Friday, good morning to you. Equity futures negative on the S&P, on the NASDAQ 100 too. On the NASDAQ, we're down about 1%. Just over the last 20 minutes, we take another leg lower. On the S&P, we're down 0.5%. Crude softer, negative 0.6%. WTI at 116.18. Tesla down by more than 4% off this Reuters report, citing an internal email at Tesla that they're looking to pause all hiring worldwide and maybe cut jobs by 10%. The thoughts of Dan Ives of Wedbush, Tom. He says the following: the street knows soft deliveries for June quarter already on the horizon due to China issues. Cutting costs is prudent now. He goes on to say, Tom, the elephant in the room remains the radio silence on the Twitter deal. TK, when was the last time we talked about that?
Am I bored by it? Yeah, I think people can tell I am. But you're right, John. There hasn't been an update. And again, what I don't get here, John, help me here, is why does this guy have a different playbook with the SEC than any other chief executive officer in the land?
What would you like to see Gensler do?
You got to do this. It's great what he's doing. Do it by press release. Do it by a traditional way that disseminates to all shareholders at the same time.
Lisa, you're drawing the line between this internal email cited by Reuters this morning and the communication on getting back to the office a little bit earlier this week.
I just am wondering what the motivation possibly is. He's got the Twitter deal that he hasn't mentioned. He has these supply constraints that you have over in China. What's he really doing right now? Does he really just want to talk about a super bad feeling, get some therapy for that? Again, what's his motivation?
It's a sensitive, Lisa.
You're sensitive, Tom. Futures down 0.5%. Payrolls coming up a little bit later.
On oil, and a guy who writes hyper-detailed, brilliant notes out of Washington with Clearview Energy Partners. Kevin Book joins us right now, head of research. And what I love is you go to the emotion of it, Kevin, and I lived it. Get out the cardigan. James Earl Carter said, I'm going to wear a cardigan sweater. My father was the only one who actually turned the thermostat down to 40 degrees. This president doesn't wear a cardigan. He wears aviator glasses. He drives a Corvette at 20 miles per gallon. Does President Biden have the culture to do the Jimmy Carter redux?
Good morning, Tom. I think Biden in a blazer with the aviators has learned that you don't get reelected putting large Americans into small cars. Look, my parents had 2 cars, 1 siphon. Nobody wants to live that way in America today. Also, if you look at the world writ large, we're looking at prices right now, but not shortage. A physical lack of molecules, that's a different world, a world apart from where we are just looking at pain in our pocket.
Can we get to shortage?
Sure. We're looking at some possibilities. Some parts of the products mix. We looked at a very lean New England diesel situation just recently. These things are possible with interruptions in the supply that come from unanticipated events.
Kevin, let's talk about policy. What can this administration actually do to alleviate some of the pain at the pump?
There isn't much. You can see they've already done a heroic drawdown of strategic reserves. They've already taken on everything they can in the way of messaging, except, of course, what Tom mentioned, the conservation message. That's the European message, different flavor. But at this point, they're looking into blame deflection mode. You have a direct inverse correlation between approval ratings and pump prices on a real basis of the negative 0.5 from Reagan forward. Biden's is even more negatively correlated. This is a time to come up with an explanation because it's not easy to come up with an answer.
Kevin, what we saw from OPEC Plus, is that basically an olive branch to Washington, to the European allies, or is it something perhaps a little different than that?
Well, there's some self-interest probably baked into this. OPEC doesn't want to kill its customer. But there are there may be some signs of an emerging thaw between Riyadh and Washington. For one, I think we're headed towards let's call it a Mojo summit. And ahead of that, we saw some recognition yesterday from the White House for the Yemen truce continued. Karine Jean-Pierre specifically called out the Crown Prince as part of the sealing the deal on that. Also, OPEC got recognition there too. I think in terms of whether we actually get to a pivot, let's see where the Iran deal goes before we decide that the White House has abandoned Iranian barrels for Saudi.
Kevin, there's also always a question of OPEC Plus's credibility. At this point, they're talking about increasing production targets in nations that have shown an inability to actually increase their output. How much of a credibility issue does this become? How can we actually gauge the real extra barrels that they're putting on the market?
Yeah, at a 2.7 million barrel per day deficit relative to headline, you're getting a lot of phantom barrels in the mix. And they matter on paper because without the number going up in the spreadsheet, it can't go up in the tank. But it also means that some of what you're promised isn't likely to be delivered. Moving Friday into a mix of Wednesday and Thursday still ends up with an empty tank. Bottom line on this, there's room to the upside, but there's real questions about spare capacity. At this point, we have to ask if Russia is being structurally shifted out of the market by sanctions aimed at degrading its power to produce energy, and that is the explicit goal of Western leaders, then one of the biggest parts of this story, one of the 3 legs on which the global oil market stands, is being cut slowly. There's no way to hit those numbers in that case.
Kevin, what is in your sustainable gas per barrel? It's a number, folks, below all the emotion that's out there, but is the new $60 a barrel 80, or dare I say the new $60 a barrel is $100 a barrel?
Well, you know, the historical average is a poor metric, $37 a barrel or whatever it is in real basis. On the other hand, the last 10 years might also be a poor metric. We've had a pretty high price band writ large. When you say sustainable, the question is, where does the marginal barrel come from? We already know the shale patch can deliver lots of barrels and isn't delivering as much as it used to. So the profitable shale barrel price is probably a register higher than the one we saw in the last decade when it was balancing global markets so ably.
Kevin, awesome to catch up with you. As always, Kevin Book there of Clearview Energy Partners. I was just bringing up the latest crude output data, Tom, here in the United States, pushing 12 million barrels a day now, 11.9. It has picked up. has picked up in a big way over the last 12 months.
Well, we've had a number of guests say, yes, there's a problem in the United States. I would say Paul Sankey has been most articulate on that. But, John, the fact is price solves problems, and there will be a price where production clicks in with a vengeance.
Well, Tom, let's pick up on that. What's more likely to happen? The supply clicks in or demand clicks lower?
I think that jets is different, airline is different, but America's desire to drive is proven.
Lisa?
It's a great question. I don't think it's clear. I think it's very unclear at this point, given the fact that there has been a fiscal discipline, as a lot of shareholders talk about in the shale patch. They don't want to invest in new wells. They were burned in 2014. They don't want a repeat of that. So then what happens when you get $6, $7, $8 a barrel? $8 a gallon. How then do you see the demand potentially respond?
I thought Kevin Book was brilliant there, Lisa. And what's really important is you and I go to the weekend with children, is we'll be in blame detection mode. I like how he used, I'm going to steal that phrase from
blame detection mode? What are you, you detecting blame from them or they're detecting blame from you?
It's symmetric. But, you know, you and me in blame detection mode. There it is. It works.
Thank you.
You with us, John?
I was just wondering where you're taking this.
Well, you know.
Okay.
Summer weekend.
All right.
I'm detecting blame.
Futures down. This is Bloomberg.
Nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
No matter how you slice it, I think you are seeing a very tight labor market.
We're still seeing a record demand for labor, and the supply side is falling well short.
The Fed needs to loosen that up, or wage pressures will accumulate.
I just don't see unemployment ticking up significantly anytime soon, given how many unfilled jobs there are.
The more of these numbers that we get that show that the economy is slowing but not cratering, that's going to be taking pressure off the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures lower by 0.5% TK. The jobs report 90 minutes away.
And the jobs report that matters is this one, and then on we go. And John, I'm going to go right to Labor Day, the end of the summer. September 2nd is the biggest jobs report of the year.
And then into the end of September, a Fed meeting, Tom, and this big debate about whether we get a pause. We've had pushback from Governor Waller, then pushback from Vice Chair Brainerd.
Are we going to be at neutrality as we end the summer? And on Julia Coronado, I thought was brilliant, laying out the Fed plan, or if you will, their hope. And you really wonder, John, do we get into blame destruction mode in the autumn months as we try to figure out where neutral is? We're going to learn some data this morning.
We've had a lot of complaints this week. We heard from Jamie Dimon earlier in the week. He said a hurricane was coming. Then Tesla, Elon Musk, Bramo, with a warning internally, according to Reuters, in an internal email, saying he's got a super bad feeling.
Yeah, I've had that song in my head. I've got a feeling all morning as a result of
Super
reading
bad.
that. Super bad. You know, what does this actually mean, right? Can we take Elon Musk at his word that there is something behind this? 10% in terms of how much of the staff he plans to cut is rather specific. So is he looking at supply chain issues in China? Is he looking at demand issues? Not necessarily. What's going on here to really lead him to actually have this super bad feeling?
To build on a conversation we had in the last hour, we did talk about companies failing to come out and talk about how bad things might be in the future, and then having the stock move by 20, 25% on any given day. We're starting to hear more and more from companies now. Bramo, we heard from Microsoft yesterday, a little bit from Tesla today, others still to come.
And the response to it, as you pointed out last hour, has been much more in line with taking things in stride and being more okay with what they have to say, even if it's negative. I mean, Microsoft, talking about a $600 million charge due to higher, the sort of stronger dollar. There is a difference in the tone, in the type of revision, the type of guidance. Do you even consider Elon Musk's super bad feeling guidance, or is that just, prognostication to internal executives?
And that's probably the problem. As for Microsoft, down 4% at one point, positive 0.8% at the end of the session yesterday. Tom, if you look at Amazon, I think we've had a mini bull market on Amazon stocks. It's been hammered recently, but over the last few weeks, it's up about 20%, I think, since the lows of a week ago.
John, you bring this up, and I really don't want to give my opinion on this, but I'm going to say, given times of stress, free cash flow and free cash flow growth wins out, and you can pick those stocks off the Bloomberg and discover if you think they're of value.
Some people will be keen to call this, of course, a bear market rally, a squeeze, if you will.
You're always going to see that, and we don't pontificate on the technicals of an intermediate bull market within a bear market and all that. I'm just going to pontificate, John, about the underlying economics, which I think we see as a pretty good American economy with a Fed that's got a lot of lifting to do.
I think it's fair to say we pontificate about plenty of other things, Tom. Futures right now, down 0.5% on the S&P. On the Nasdaq 100, we're -2. Down 0.9%, taking a bite out of a weekly gain on the S&P 500. In the bond market, yields just a little bit higher on the session, on the week by a whole lot more. Your 10-year 291.50. And looking at the commodity market, just a little bit softer here, lower. We're -0.8%, Lisa, 115.97.
If we're data dependent, what data are we watching? At 8:30 a.m., a lot of people have been watching jobs, saying that this is the most important indicator for the Federal Reserve, and frankly, for what kind of deceleration we may expect. We do get the labor market report for the month of May coming out. I'm watching the participation rate, people coming back into the market after leaving during the pandemic. Will they come back? A lot of people were saying they should come back. This is what is sort of the hidden slack, but we really haven't seen that to the same extent. And that will be one mystery that perhaps we'll get a tea leaf for today. Also today, we're going to hear from U.S. Labor Secretary Marty Walsh, speaking to our own Jonathan Farrow today on Bloomberg Television at 9:30 a.m. How does he dovetail a good report into the inflation? How does he talk about a bad report and how this has really been a talking point for the administration in terms of the momentum of the underlying consumer? And then President Biden will be joining and speaking from the Rehoboth Beach Convention Center at 10:30 a.m. He will be in Rehoboth, where he has a home for the weekend. And at 10 a.m. we get U.S. May ISM services data. Really, this has been one of the issues that people have been looking at. There has been real strength and, frankly, a lot of inflation coming through from the services, even as you get a deceleration in some of the inflation from goods. Do you see that continuing? Have you started to see a pushback from consumers, John, based on the higher prices that they have to pay to go out to eat, to stay in hotels, and do other things around?
That's one to watch. The ISM manufacturing was a decent upside surprise this week for me and for others too. Looking forward to the data a little bit later. Lisa, thank you. Priya Misra joins us now, Head of Global Rate Strategy for TD Securities. Priya, let's start here. You think a pause is brewing at this Federal Reserve. We've had pushback against that view from Governor Waller, from Vice Chair Brainerd. What makes you think that's what's developing here?
I think it's all about the data. So, do the monthly prints of inflation, do they start to decelerate? I think Chair Powell calling it a clear and convincing signs of decline implies that if those monthly prints start to decline, now I'm not sure if is that September, is that November, is that early next year? It's somewhere in that range. We think these monthly prints of inflation decelerate. We also think that growth starts to decelerate. I think there's demand destruction happening every day. The big question is how much of that savings buffer is still there for the consumer. We think some of that starts to wane. It's declining again every day when you're at the gas pump or at the grocery store. Mm-hmm. And if the job market starts to show some moderation, which we are looking for, I think then the consumer starts to pull back. So a combination of these monthly prints, I'm going to argue data is extremely important. I would almost say that the Fed is trying to retain optionality. I think the data right now trumps Fed speak because they're going to be extremely data dependent. They really want to see that monthly deceleration come in.
Priya, in 83 minutes, we get a report, and you've got emblazoned on your note that it will be an asymmetric reaction. Lay that out for us for the 8:30 report.
So I think, the labor data has been very strong. And so I think the market's pricing in a strong number, maybe some moderation, but a strong number, strong wages. I think if we get a weaker number or we get weaker wages, I think the market's going to get really concerned that this growth moderation that we're talking about is here. And I think the big question we're all grappling with, the equity market's grappling with, is are we moderating to trend or are we going below trend? And if there is a reasonable slowing in data, I think people are going to get nervous that we're going below trend. There's a fine line. Chair Powell talks about lowering job openings to actually laying off people. And I think as the market starts to say that, well, at what point do employers say we're not just cutting job openings, we're actually letting people go? I think that becomes really something that risk assets as well as the rate market's going to price in. So I think it's asymmetric. I think a strong number is priced in. You get a weak number, and given that we all know that the labor market's a bit of a lagging indicator of the economy, I would say ISM, sentiment, the soft data would be somewhat of a leading indicator. If the lagging indicator is showing more of a slowing, I think the market's going to get pretty nervous.
This is interesting, Priya. Some people would argue that it gives the Fed more room to actually pause or perhaps hit the brakes a little bit with how quickly they'd have to raise rates. And that could be viewed as a positive because it might actually lead to something softer. Why do you push back on that idea?
So fair point. I think inflation's just too high. So they really cannot right now, I think, suggest that they're going to slow. They really need that clear and convincing sign. I mean, I'm a little nervous when Governor Waller says he wants to see 2% inflation because, frankly, the Fed can't control a lot of the increase in inflation. And so I think if they're targeting 2%, and I'm not sure that the committee is there, but if they're targeting 2%, there's no way they can sound that concerned about some slowing in growth. If they're targeting a 3.5 at the end of this year, or even 4 at the end of this year, that convincing decline, I think at some point when they're at neutral or a little bit above neutral, they can start to slow down. But right now, we're well below neutral. QT has just started. I don't think you're going to get a lot of comfort from the Fed. And so, which is why I am, nervous about risk assets here. I think that is looking for that Fed put. I think that put is pretty far away given how high inflation is.
Priya, tell me where the long end of the bond market is then for you through this year. 320 the high of the year, early May, about 290 right now. German 10-year yields making new multi-year highs day after day this week. Where are you on that story? Have we seen the highs?
So our forecast for year end is 320. So you could argue that we just about touched it. I think we're going to be very range bound. I was more bearish, I would say, on treasuries a little bit earlier in the year, but we've had a pretty big move in higher in real rates. And now the market's concerned about growth. So I think we're going to stay in a 275, 3.25 type 10-year. I think we'll be extremely volatile within the range because the market's going to go from high inflation, Fed's going to hike a lot, to they're going to overdo it. And I think that's going to keep us fairly range bound, even though we'll move a lot on a daily basis as the narrative shifts. It feels like, every day we have a different narrative. But I think that range holds for the rest of this year because we're just in this uncertain environment about how much we're slowing and how's the Fed going to respond.
Priya, one of the very best. Great to catch up with you on Payrolls Friday. Priya Misra there of TD Securities. TD at 300K for payrolls, Tom. That number, 1 hour and 20 minutes away.
Is that the key number we care about? I don't think so. I think this is a time where, let's review this, John. In pre once-in-a-lifetime crises, 200 was where we were. People would model 150 as quote-unquote normal. And we're still in this pandemic recovery, big numbers of 300-ish.
Inevitable, Tom, that I think we get some kind of deceleration.
Yeah.
In fact, some people very constructive on the economy expect some kind of deceleration. As always, you can never just look at that number in isolation. What does it look like relative to the rest of the report? And how much more demand does it take to squeeze out more wage growth from this labor market, given how tight things are? Maybe not much.
We got to look at ECB as well. Sebastian Galli and I going back and forth, John.
What's he saying,
He's at a
Tom?
118 euro 12 months out. Strong euro from Galli of Nordea.
Out of all the trades out there, Tom, that is one of the most divisive ones, I think, right now. Lisa and I talk about it daily. Is it currency positive or currency negative that this ECB is going to make a move and make a move into some weakness? Euro dollar right now, 107.36, negative 0.1%. Coming up in the next hour, Nadia Lovell of UBS on an equity market that's been in better times over the last couple of weeks. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Tesla CEO Elon Musk reportedly has told executives the electric car maker needs to cut staff by about 10%. According to Reuters, Musk sent out an email titled "Pause all hiring worldwide." The report says that Musk wrote that he had a, quote, super bad feeling about the economy. A 10% cut at Tesla could mean a loss of almost 10,000 jobs. President Biden is pleading with Congress to toughen gun laws following a number of mass killings. In an evening address from the White House, the president called for a ban on assault weapons and high-capacity magazines. He acknowledged that lawmakers are unlikely to ban the weapons, so the president called for raising the age to buy them from 18 to 21. According to the UK's Defense Ministry, Russian forces now hold the initiative in Ukraine 100 days since Vladimir Putin launched the invasion. British officials say the Russians have gained momentum in their push to capture the Donbass region. They said the original Russian plan failed, but Moscow has since changed its goals and now is focused on the Donbass. Global food prices stayed near a record in May. A United Nations gauge of costs fell 0.6% from the previous month. Russian invasion has sharply reduced exports from Ukraine. That's one of the world's biggest shippers of both grain and vegetable oil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated.
Larry Fink there, the BlackRock chairman and CEO, sitting down with David Weston. Fascinated conversation. Futures this morning, and good morning to you. Negative 6 or 0.7%. On the Nasdaq 100, now down a little more than 1%. Tesla not helping out things right now at all. That stock is negative in the pre-market. We are down, Tom, by around about 3 or 4% on Tesla through much of this morning.
Well, watch Tesla, I guess watch Twitter as well. As somebody said that, that's a story that's been pushed aside, and maybe over the weekend it comes up again as people rationalize forward. We're going to really focus here, folks, on 8:30 a.m., which is not an historic jobs report, John, but let's consider this as a nuanced and important report.
It's a series of data we're expecting, Tom, and I think you've been right about this, through the next several months into September, and this big conversation about whether this Fed ultimately has to take a pause around then after hiking 50 basis points twice over the next couple of meetings. That's where the conversation is.
Maria Tadeo with us for the conversation in Brussels, and of course a war-torn Europe, and Emily Wilkins in Washington this morning. Let me go to both of you on the summer. Emily, the summer for you is completely dominated by the first Tuesday of November, isn't it?
It is, Tom. I mean, we're seeing a number of really interesting primaries. We've had a number this past month. We've got a number coming up. And kind of the big question, I think, that most people in Washington are looking for here is exactly how far the hold of former President Trump still has on the Republican Party. How well are his nominees doing? Are they winning? At this point, we've seen evidence both ways. We've seen Donald Trump be able to score some victories, but we've seen other places where candidates where he has not endorsed come out and ultimately win their primaries. Then, of course, the question is the general, the fear that maybe some of these candidates who Trump has supported won't be able to get the support they need from independents to ultimately pull off a victory.
And Maria, your summer is the oddest summer I think I've seen in my lifetime. It's a massively boom economy and tourist economy across all of Europe. Witness every image of Paris, London, and the rest in the airports. And yet, do you have a clue where the war in Ukraine sits the end of the summer? We have no idea, do we?
Yeah, no idea. And Tom, going back to your point about this boom that we're seeing on the touristic front, I was in Madrid a week ago, and I promise you could not find a hotel. You could not find a flight. I was in Paris. You could not find a decently priced hotel. So clearly there is this idea that, yes, Europe is going to reopen this summer. Finally, coronavirus has passed us, and this is the right time for the European economy to tap into what it's very good at doing, which is, of course, welcoming tourists and tapping into the the service industry. The issue, of course, is that for the European leadership, they have to keep Ukraine on the map. This is something that they believe is not just a matter of politics, but almost values. The big difference, perhaps in terms of perception, between the European Union and the United States is the close proximity. We're talking about a war that's lasting now for 100 days, that is 2 hours, 30 minutes on a plane from where I am. For the European officials and then the European system, it's very hard to stomach and get used to something that looks like Syria in Central Europe.
Maria, to this point, is that the reason why inflation at the highest levels in history in the Euro region are not garnering the same sort of political response and political liability that they are in the United States?
Well, it's funny because it's a very similar narrative here. They talk about imported inflation. So they say all of this is happening as a result of the war in Ukraine, the energy shock that has been this invasion. They point to Vladimir Putin. They point to the Russians. And they talk about all of this imported inflation. It's not the result of bad policy. Of course, all of this is up for discussion. But I think in Europe, and this is, again, another cultural difference with the United States, there is this clear separation between the European Central Bank, the European Commission, and the governments. They don't want to get too involved because they feel that could really damage the credibility of the euro, and we know that in the past that had been questioned. So of course they don't want to go there, and they don't want to openly criticize Christine Lagarde. But we are seeing, though, that there is criticism from other members of the ECB. So we'll have to wait and see how this almost peaceful period can continue if inflation goes up like the way it has been for the past 2 months.
Emily, President Biden doesn't have the luxury of trying to keep his hands clean from the issue of inflation and say that the Federal Reserve is its own body and we want to defend the dollar. How is he going to respond to a good and a bad employment report? How much is the messaging going to shift?
Well, I think we're going to see the messaging actually shift a little bit, perhaps with this employment report. We're expecting Biden's remarks to be at 10:30 today. And he kind of hedged a little bit on this jobs report in an op-ed earlier this week, saying, look, if we don't have astronomical growth like we've experienced in previous months, that's actually okay, because we're going to be moving to a new stage of recovery, and it is going to look like some smaller job numbers. But I think at the administration, they still need to be able to point to low unemployment and to be able to point to a good job market, because they certainly can't point to inflation. That has been high, that has been higher than they initially expected it to be. You actually heard Treasury Secretary Janet Yellen admit this past week that she had been wrong about inflation and how long it would last. And so Democrats understand that's a huge liability for them, and they're really trying to switch the narrative to, hey, look at unemployment, and hey, we're doing what we can to try and bring prices down elsewhere with supply chains, with legislation looking at supply chains, and with executive orders that we saw this week from President Biden targeting food producers and farmers.
Emily, just quickly, what's the future of some of those voices, those economic voices in the White House at the moment, in Treasury too? Are we going to see a change in the coming weeks?
I mean, I think to a certain extent we have seen that pivot going from saying that this is only a temporary inflation to the sort of buckle up, we're in it a little bit more for the long term. And I think to a certain extent you're hitting the point where White House officials are, you know, there are certain factors that are beyond their control. They're trying to control the factors that are within their control, what they can do with oil, what they can do with food prices, what they can do with the supply chain. And I expect them to just try and keep the message on what they can do. Difficult, of course, because Republicans will be continuing to push the narrative that this high inflation is a direct result of the COVID bill that was passed back in 2021 that pumped billions into the economy, and Republicans are very much tying that with the high inflation we're seeing now.
Emily, thank you. Awesome as always. Emily Wilkins there alongside Maria Tadeo. Speaking of high inflation, you mentioned Europe as well. Lisa, let's talk about it. 8.1%, the data point earlier this week. You have to give a hawk something to be unhappy about. So they're going to push for the 50. The fact we're even thinking about doing 25 basis points of the ECB anytime soon, Lisa, that's such a massive change from where we've been over the last 8 years.
Remember we were talking about negative yielding bonds, that Austrian 100-year bond that really hit Tom's portfolio. There is this question why we have not seen more volatility stemming from a complete reset of the negative yielding regime in Europe. And this is coming on the heels not only of a 25 basis point rate hike expected by the ECB, but a 50 basis point rate hike was priced in for September in the latest Fed funds futures or the ECB futures. So I'm looking at this and I'm just thinking, can they? What does that mean?
Well, let's be clear about one thing as well, Tom. Yields are still climbing over there. They're still climbing. Haven't seen the high yet, for some people at least.
And again, you know, Sebastian Galli, I'm going to say, is an outlier. 10 big figures on the euro out 12 months. Are we mentally, John, there for that strong euro? I don't think so.
126 on a German 10-year this morning, up a couple of basis points. Yeah. Another multi-year high on a German 10-year in today's session. Coming up, Ellen Zettner and Morgan Stanley. Looking forward to that conversation just around the corner.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Jamie Dimon says a hurricane is coming. Elon Musk has a super bad feeling. A lot of that going around at the moment. Coming into Friday, though, on the week, the S&P 500 just about positive by 0.5%. We pulled back now on the S&P 500. Futures negative 0.6%. On the Nasdaq 100, down about 1 percentage point. Just about poised for a second week of gains before today's price action. We'll see how things evolve. Into the bond market, 2s, 10s and 30s in the Treasury market. Yields higher on the session, on the week by about 18 basis points, on the day by a basis point or two on a 10-year to 292.41. Never mind the conversation about the Fed, we've got to have a bigger one about the ECB. Into next week, June 9th, setting the stage for a rate hike July 21, according to UniCredit and many others as well. Here's how we look in the bond market in Germany. If we had a move of the week, for me at least, for others maybe as well, it's on a German 10-year yield. That bond yield's up 30 basis points over the last week, Tom. That's an important move.
Again, you see it on euro versus yen as well. John, I think what you stated at the beginning there about the gloom that's out there, and we really need to reframe the reset, which we have been more optimistic on. Even Lisa's been more optimistic. And I just simply look at the jobs day VIX, which is real simple. We went in from the May report to this June report, we've gone from a 30 to a 25. And that's a constructive tone that isn't in the comments of Mr. Musk and others.
Is that your benchmark? Even Lisa has been slightly constructive.
Even Lisa's,
hold on.
Lisa, you can speak for yourself.
Thank you. I appreciate that. Look, people say I'm bearish. I try to look around corners. I'm going to bring that back.
There we go.
And this is the issue, right? I hope that I am wrong, right? I hope that everyone who's trying to push back against the possibility of a soft landing being fantasy, I hope all of those people are wrong, myself included. I think the issue is you see a lot of potential headwinds that are coming out in different ways, and you're seeing executives talk about them. So, you know, I worry about them. It's just my genetic predisposition.
Lisa, what do you make of how the market has responded to the incoming information this week? Just think about things from Governor Waller to Vice Chair Brainerd pushing back against that pause, Microsoft essentially pre-announcing warning about foreign exchange, Tesla and Elon Musk, do whatever you will with that. What do you make of all that information and the fact that actually, considering where we've been, a little bit of resiliency starting to come through?
The consensus, in my view, this week has been that people have gotten ahead of themselves with recession talk. That, frankly, there is just too much strength in the U.S. economy to lead to a recession in the next 12 months. That seems to be the consensus right now because the incoming data is still strong. So there is resilience. What pushes back against that if the Federal Reserve does go more aggressively, upending some of the narrative from the previous week about a possible Fed pause?
That wasn't that bearish.
Thank you.
I don't accuse you of being a bear at all. What was that? We'll leave that. That was a cross-asset price section. Let's get you some single names. And that move in Tesla, top of the pile. Good morning, Romain.
Yeah, a pretty massive move here, down about 5%. Remember, this was a stock that had finally started to get its mojo back after dipping back into the 600s here. But that commentary, at least based on the reporting out of Reuters, out of Elon Musk and that memo, not only about a hiring freeze, but of course about that bad feeling, of course, in Elon Musk's stomach. And, you know, look, there's a lot of talk about a recession and whether we'll get to one. But a lot of executives are really saying it's not so much about if we dip into a recession, it's about the idea that there's still a little bit of a slowdown in sentiment and in spending. We heard that out of Gary Friedman, the CEO over at RH last night. And it was interesting commentary because remember, 3 months ago, he kind of surprised the street when he came out and said then that he thought that there was a lot of softness, not only in what he was seeing with regards to RH, but what he was interpreting as broader global macro conditions. He talked a lot on the conference call about the Fed and interest rates and how he was really worried about how aggressive the Fed would be and what type of impact that would have on macro conditions. Those shares down about 4%. That company now guiding a lower here on a full year basis, saying sales will basically be flat to up 2%. And then Coinbase last night came out and said that the hiring freeze that it implemented about 3 weeks ago is now going to be extended, and they're actually going to rescind job offers that had already been made. Those shares continue to move lower, down about 4% here on the day. So just a collection of at least 3 CEOs here who are sort of looking at the tea leaves right now and at least preparing for something that's going to be a little bit, I guess, worse than good, if not necessarily a recession. Flip it up real quick. Let's take a look at some of what's going on in the M&A space. Coal shares higher, up about 7%. There was supposed to be a deadline today for new bids to buy this company. Dow Jones reporting that 2 came in, one from Sycamore in the mid-50s. Remember, Sycamore bid for this company for about $64 a share earlier this year, and Coal's rejected that, so take that for what you will. Another bid is on the table over from Frontier Partners. Turning Point Therapeutics, more than doubling here in the pre-market after Bristol Myers said it's going to buy the cancer developer, and Spirit Airlines shares moving slightly lower here. 2 of the big investment advisory firms, Tom, out there are recommending Spirit Airline shareholders take Frontier's bid to buy that company over JetBlue's.
Romain, thank you so much. To close this afternoon, John, there is again an indication of strident nominal GDP. American Airlines, like the others, the ball out of the park.
Here we go, volume 2. You saw it with Delta a couple of days ago. Here it is from American Airlines. They see the second quarter revenue up 11 to 13% versus 2019. Previously, they'd seen it up 6 to 8%.
These are huge moves.
That's a big lift, Tom. The revenue increase driven by demand and pricing strength, And the capacity story, it's the same old story. They see the second quarter capacity story, Tom, at the low end of prior guidance. Anyone who's tried to book a flight in America, Tom, is not surprised by this at all.
There it is. It's the data from, granted, it's supple. Travel could go ebb and flow. Let's go right to it with Ellen Zentner on this job day. She's chief U.S. economist at Morgan Stanley. Ellen, when you look at the airline boom, I equate it with a booming nominal GDP. Do you guys have a grasp on the trajectory of nominal GDP that may possibly signal a slowdown at American Airlines out there?
Yeah, so I think, look, we have to get past a surge of demand for services. And I think that's been well telegraphed, right? So think of what we experienced with goods purchases and goods prices when that pent-up demand was coming through. Well, now we're continuing to shift that toward services. Everything, Tom, comes down to the labor market. And as job growth slows, and I take to heart what companies are saying that Romaine had pointed out, that you're going to see hiring freezes, that you're going to see some of these open positions closed certainly by the end of the year. I'm going to be watching that because once the pent-up demand is filled, ultimately income drives consumption and labor income in particular. So nominal GDP is strong now. It's not going to be as strong for the full year. But we're still talking about 6% growth rates on nominal GDP this year, which is quite high, but not as high as double digit, which we had last year.
Ellen, it seems like there is a consensus right now, at least this week, that it seems unlikely that there is going to be a recession in the U.S. in the next 12 months. 24 months, maybe it seems more likely. Do you push back against that as overly complacent, or do you think that that looks like a base case?
Yeah, Lisa, so I think it's easy to go out 2 years on the horizon and say, yeah, the probability of recession is quite high. And recession probabilities rose the moment the Fed started talking about hiking, because monetary policymakers tend to hike until something breaks. And then Chair Powell is confident that he can course correct quickly and keep the economy growing. And so that drives recession probabilities. What we are complacent around is that over the last couple of decades, we've had very low inflation, and we forget that high and accelerating inflation is what typically has led to recessions. And so it's important to include that in a recession probability model. And ours is saying 35% chance of recession over the next 12 months. That is non-negligible. And we're watching to see if that continues to rise. It's been pretty sticky around 30 to 35, but certainly we're watching to see if that rises.
What's the leading indicator going forward, just in terms of whether you're looking at some of the consumer data with respect to the University of Michigan sentiment, or whether there's something else?
Yeah, so sentiment is very difficult to gauge that as a leading indicator. I mean, certainly, rather than headline sentiment, I do put some weight in buying plans, which are down sharply for some of these large durable goods categories that do suffer from higher interest rates and already pent up demand that's been satisfied. So I'm not sure that those are telling me recession, more so than just a slowdown in consumer spending. But what households do in terms of their approach to home buying does matter. Residential investment, small share of GDP, but the tentacles of housing reach far across the economy. And we used to say, so goes housing, so goes the business cycle. And so we're seeing structural shortages in supply, strong demand that's finally driven affordability to astronomical levels. And we want to be sure that we don't see a very sharp correction in housing, but sort of a guide lower. So continue to look at things like building permits as sort of that traditional leading indicator. Jobless claims is that traditional leading indicator.
Ellen, 50 minutes away from the jobs report. If I could give you one data point right now from that report, just one number, which one would you like?
One number, the labor force participation rate. I know we sound like a broken record here every month. I want to continue to see the prime age labor force participation rate pick up, because we need to create slack in the labor market. And that's one healthy way that we can do it.
Ellen, fantastic to hear from you, as always. Ellen Zentner there of Morgan Stanley. Looking ahead to payrolls, 318 is now the median estimate in our survey. That jobs number drops in about 50 minutes. I think we should return to this American Airlines news. It was down too early in the week. It's American. If you speak to the retailers, Walmart, Target. They'll tell you things are tough right now for them. You speak to the airlines, and this consumer is looking strong. According to them, at least, Tom, revenue up 11 to 13% in the second quarter is the guide now from American versus 2019. They had previously seen it, Tom, up 6 to 8%.
People choose. Let's compare and contrast this news of this sector, John, with what we saw with Target, Walmart, and the rest in retail. They're making choices across deciles of the American economy, and particularly with inflation, certain deciles are crushed and others just keep on moving.
Stock's down about 0.9%. Lisa, we're getting used to this story from these guys, aren't we?
Yeah, definitely. Although you do wonder if it's just a tale of two sides here, with certain places seeing those gains and others not so much.
Futures on the S&P down 0.7%, on the Nasdaq down a little more than 1%. Your jobs report is 49 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Ritika Gupta. Today's U.S. unemployment report is likely to show the smallest gain in jobs since April of 2021. The median estimate in the Bloomberg survey says 318,000 jobs were added in May. Meanwhile, the report also may show a downshift in average hourly earnings growth. Meanwhile, a report from Reuters says that Elon Musk wants to pause hiring at Tesla and cut almost 10,000 jobs. Musk emailed that he has a super bad feeling about the economy. BlackRock CEO Larry Fink expects inflation to remain elevated for several years. Fink told Bloomberg TV the primary reason is snarled global supply chains. He said the Federal Reserve doesn't have the tools on its own to fix those supply problems. In Turkey, annual inflation soared past 73% in May. That is the highest going back to 1998. Consumers saw food and energy prices jump, whilst ultra-loose monetary policy contributed to the weakness in the lira. Turkish inflation has been in the double digits for much of the past 5 years. Authorities have prioritized economic growth and exports. Bristol Myers Squibb has agreed to buy cancer drug company Turning Point Therapeutics. The all-cash deal is valued at more than $3.7 billion. That represents a 122% premium to Turning Point's closing price on Thursday. Bristol Myers expects the deal to close in the third quarter. And American Airlines says it is doing better than expected in the second quarter. The carrier estimates revenue will be up some 11 to 13%. That is versus its last pre-pandemic year, 2019. Earlier, it had estimated a 6 to 8% rise. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's so politically sensitive and why the Fed officials will never come outright and say it. But I think implicitly they do need the labor market to cool, and that's probably going to involve the unemployment rate ticking up just to relieve some of the inflationary pressures that's stemming from the labor market.
Sarah House there of Wells Fargo going into the payrolls report about 42 minutes away. Good morning to you all. Futures are negative, down 0.7% on the S&P. On the Nasdaq, rolling over just a little bit more, down a little more than 1%, negative 1.12%. Yields a bit higher by a basis point, 291.86. Andrew Hollenhorst and the team over at Citi just publishing, we see upside risk to wage growth, downside risk to the unemployment rate. They're looking for 3.4% today. They say a tighter job market with stronger wage growth would be a hawkish development, Tom, even if job growth slows to around 315K or even below.
Yeah. And Alan Ruskin, John, publishing moments ago after Lisa grilled him in the last hour. And I love what he says. He says, look, this is going to be a Goldilocks era, not too hot, not too cold. He says that is good for risk. And then he goes on, as he said with Lisa, that he looks for cold porridge down the road.
Getting some headlines out from Tesla too, Lisa.
Yeah, honestly, we've been talking all about how Elon Musk is going to be coming out and possibly cutting 10% of his staff. John, at what point does this really raise a liability going forward?
The stock is down by around about 5% this morning. Tom, I think some of that contributing to what we're seeing on the Nasdaq today, down about 1.15%.
Right now, an update. We could go an hour and a half right through the jobs report with Mandeep Singh. He's our senior technology analyst at Bloomberg Intelligence. It's an extraordinary team. Mandeep, I guess I got to go with Tesla first, just because Mr. Musk has forced himself into the news. Let's start with first principles before John gets technical. Is Tesla a tech company or a car company? It's an ageless question.
Well, so clearly they use a lot of AI for, autonomous driving, and that kind of puts them in that tech bucket. But at the same time, fundamentally, it's an EV car company. And look, they've been at the cutting edge when it comes to, a lot of the innovation they've done on the EV side. But they have a lot of engineers who are working on AI. In fact, they pushed out their AI day by a few months now. So clearly, there is a lot going on. And look, we saw that with advertising getting pulled back, Microsoft cutting guidance. So it's not a surprise that Tesla is kind of going with this, just job cuts, team, and a pullback in guidance overall.
Mandeep, what is Elon Musk a massive liability for a company that is a publicly traded company? This is a serious company. To have someone coming out and basically talking to executives that he has a super bad feeling, how much does that undermine the credibility of this public company?
I think it's just an acknowledgement that they aren't seeing that kind of demand tailwind that was there because of reopening. So I don't attribute it to, specific to Tesla. Every company out there is noticing some sort of demand deceleration. And look, he's probably ahead of the curve in terms of announcing job cuts, but the sense that we are getting is businesses are pulling back. They pull back aggressively on advertising, and so slowly it's trickling to the rest of the economy.
How much, Mandeep, does this have to do with demand actually declining, and how much is this just simply they cannot get the parts to sell, they cannot provide the profits in the profit margins that they're looking for?
Yeah, I think this one is more to do with demand. And the reason I say that is we may be, in the early stages of noticing that, but when you model that out, 2-3 quarters out, clearly every company is seeing, some kind of slowdown in terms of the pipeline that they see. And the consumer is also pulling back. So I think the confluence of factors suggests to me this is more to do with demand weakness than, supply being in shortage.
Mandeep, given to Segui here, as we do best on surveillance, to Segui over to broader technology, given the economics, Jobs Day coming up in 35 minutes, et cetera, Mandeep, how do you adjust the value or the analysis of big tech revenue growth for the rest of the year? Do you de-emphasize it, or is it more important?
It is more important because big tech was holding, the fort in terms of showing great numbers. We saw that with Microsoft and Alphabet. And look, with Microsoft taking down guidance, even though they attributed it to FX, clearly it's a sign that the days of, beat and raise are over, especially in this cycle. So you will probably see more estimate cuts from big tech going forward. We already know what is going on with Facebook. So, Google also is exposed to advertising. So big tech will start to take down estimates. It won't be just Microsoft.
Mandeep, just quickly on the FX, excuse or reason? I guess that's the question, really, because the move in foreign exchange was pretty well established when this company reported. So what do you make of that?
Well, that just goes to show that, overall, their dollar is probably getting stronger. And any company that has more international exposure is like, FX will have a bigger impact than we anticipated a month back when we reported results.
Mandeep, thank you. Mandeep Singh there of Bloomberg Intelligence. The dollar up 4 or 5% on the year. Tom, if you go by the dollar index, I guess for me, Tom, is it an excuse or a reason?
I think it's an outcome of the rate differential. I mean, clearly rate differentials is the parlor game right now. We've been talking about Germany and in Europe all morning. What I would suggest, John, particularly in the equity space, I don't see how you have an international equity rally, which people have been calling before, I think it was since the Queen's coronation, people have been calling about an international equity rally. John, it can't happen without weak dollar.
Well, let's say you get that weak dollar, Tom, because the ECB's hiking interest rates into weakness.
That's just one pair.
Is that a world you want to buy in Europe?
That's just one pair. I'm not going to make a buy, hold, sell on Europe, but you got Damien would partition this out to EM and then to commodity-based EM, non-commodity-based EM. What I'm focused on, John, is to me the ginormous elephant in the room, which is the opening of China.
And the demand there and the stimulus still to come perhaps as well, Lisa, and that's a big factor behind the more constructive view from Marko Kolanovic at JP Morgan.
Yeah, let's tease out, though, what you just said, right? Is it a symptom? Is it a reason? Or is it just a symptom in terms of the reason why perhaps there is less demand for some of these goods in multinational companies overseas? This is really the key question. Are we starting to see signs of a deceleration in demand, to Mandeep Singh's point? Or is this just noise because of differentials, because of circumstantial issues, because of supply chain disruptions? That's going to be really at the heart of a lot of jobs data as we try to take out how much weakness a lot of these companies see persisting coming from demand, not just supply side issues.
I find the dollar thing strange. The dollar peaked the middle of last month. I'm always uncomfortable when the FX excuses start.
It's always
especially when the trend's pretty well established.
Typically, that is a sign that they're trying to excuse weakness on a broader level.
Right.
This could be different, right? Because we are seeing also fundamental weakness overseas, to your point, in Europe in particular.
Nadia Lovell of UBS is going to join us shortly. Maybe we'll touch on this with her. Futures are negative about 0.75% on the S&P, on the Nasdaq 100 down a little more than 1%. Your jobs report is about 34 minutes away, and you're pretty familiar with the estimates at this point. If you're not, and you're just tuning in, 318,000 is the median estimate for the May jobs report. The previous number, 428. The number in the next hour.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
how you slice it, I think you are seeing a very tight labor market.
We're still seeing a record demand for labor, and the supply side is falling well short.
The Fed needs to loosen that up, or wage pressures will accumulate.
I just don't see unemployment ticking up significantly anytime soon, given how many unfilled jobs there are.
The more of these numbers that we get that show the economy is slowing but not cratering, that's going to be taking pressure off the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Radio, television, jobs day here in America. We'll see that in 30 minutes. And John, is just simple. Is it Target, flat on its back America, or is it American Airlines to the moon?
There's a data point for everyone, isn't there? But for the airlines, Tom, they're telling you a story about a consumer that's very resilient in the face of higher prices, a company that's being very, very disciplined about capacity. It's not just American, it's Delta, United. I give credit to Scott Kirby, Tom. He said something a year and a half ago that I didn't really believe. The business travel was going to come back and come back really quickly. He was dead on. It's back.
I'm going to go with Scott Kirby and Ed Bastian. I mean, the interviews we've had with airlines guys, with Guy Johnson has done in London as well. There's just been an underestimation of the business spirit that's out there. Will we see that, John, in today's jobs report?
Are we underestimating the resiliency and strength of this economy? And if we are, Tom, a point that Lisa has made, what does that mean about how much work this Federal Reserve needs to do to take some demand out of it to get inflation back down?
Well, Lisa, inflation is a story front and center, certainly for the president speaking later today, and for the Secretary of Labor speaking with John here after the report.
How are they going to try to position a strong labor market with this idea of high inflation and the desire for the Federal Reserve to act, to do something, whereas the only thing that they can really do is to suppress the demand and, in essence, cause unemployment to go up? I mean, it's just twist your head into this logic. How does he spin this, and where are the asymmetries of risk, Tom?
Elon Musk elbowing his way into our jobs report. John, before the data check, we've got to go hard Scott Rodino on you. Twitter out with headlines on Mr. Musk.
The waiting period for the transaction, Tom, I believe, has expired. It has expired. The Twitter deal is subject to remaining closing conditions satisfaction. Tom, whatever that means. I think that Dan Ives of Wedbush this morning called it the elephant in the room. It's been radio silent on this story for a number of weeks now.
Well, maybe Mr. Musk will go back to 1976 and look at Hart Scott Rodino to figure out what the playbook here is. He doesn't look at it. John, let's do our own Twitter moment here with the data check. I'm going to go, John, to Euro Yen, which shows weak yen, and that's part of a global tension of a potentially boom China.
I'm looking at a 10-year yield, and all of a sudden, you're looking at 3% again, 291.68, up about a basis point on a 10-year in America, up 30 basis points in Germany on the week on a 10-year, pushing 130. This line from Citi and Andrew Hollenhorst and the team from moments ago. Here's the quote. The labor market will likely need to loosen, possibly through a recession, to break the increasingly well-established wage price spiral. That's the view from Citi this morning, Tom, going into a jobs number 27 minutes away.
And that's the cold porridge that Alan Ruskin of Deutsche Bank talked about out there somewhere. Right now, before we go to important economics before the jobs report, Nadia Lovell on the physics, the math of this stock market, U.S. equity strategist, UBS Global Wealth Management. Nadia, there's American Airlines booming. How do you treat sector-to-sector analysis now, given the uncertainties of the American recovery?
Yeah, I think what you're seeing from their airlines is just continued evidence of the shifting that's happening in consumer spending away from goods and towards services. I mean, this is why one of the reasons why we have a least preferred on the consumer segment of the market, because we do think that this shift is happening faster than expected. It has implications for inventory is building in some of the channels, and that has implications for margins and discounting coming forward. And also, these sectors are still seeing cost pressures. It's becoming more difficult to pass along that third and fourth price increase to the consumer. And so this is why we think that there is some risk to the downside to earnings expectations within the consumer discretionary areas of the market.
Nadia, with that in mind, looking at the retailers, they've been punished year to date. You look at the airlines, they've got a good story to tell. You've got a resilient consumer. They've been very disciplined on capacity. I've got some relative outperformance. In absolute terms, the stock is still down for the likes of American Airlines on the year by a couple of percentage points. Do I just avoid the whole thing then?
I don't think so. You know, within industrials, we're all neutrals, but we do think that, you know, there are some pockets of opportunity in this recovery that's happening in airlines, not only in leisure. Americans want to get out this summer and travel, but also a return of business travel, which we've been waiting for quite some time to happen. We're starting to see that happen. So there's definitely some areas of opportunities within the airline segments of industrials.
But Nadia, on a broader level, what's going to drive the index higher, given that you are seeing downgrades to your earnings estimates, and that will likely continue?
I think what is going to drive this index higher, as you noted, we did bring down our earnings expectation for 2023 down to 4%. We just think that the consensus is still too high at 10%. But what could drive this market high is if we see an alleviation in the inflationary pressure happening faster than expected. If we get to, of course, PCE of closer to 2% by the end of the year, a resolution in the war in Ukraine could help that. Also, a gradual phasing out of the China zero COVID policy could also help that in terms of limiting the disruption to supply chains. But we wouldn't want China to open the floodgates right away just because of the implications of demand to commodity processed products that are already seeing elevated prices. We wouldn't want to see a spike in commodities because that could be destructive to demand.
Nadia, we've been talking about Elon Musk all morning and this proclamation that he had to some of the executives at Tesla about cutting 10% of the staff because of a super bad feeling. Aside from Elon Muskisms, how much does this represent a feeling more broadly that's not just coming from supply chain disruptions, but a sense that things are getting worse and that, as you say, Nadia, it's getting harder to pass along price increases and that a lot of these companies will have to bring in some of their staffing ambitions?
I wouldn't say we don't have a super bad feeling because we don't think that a recession is imminent. We don't see one on the horizon in the next 12 months. We put the probability at under 30%. However, we do expect a slowdown in the economy. And I think that that's needed. That's what the Fed wants, particularly on the labor market side. We need to see the labor market cool off so that the Fed can manage this economy and avoid a recession and we not have a wage spiral cycle. And so I think that that's what you're starting to hear from corporations. Again, that's also why we brought down our earnings expectations, because you are seeing potentially some softness in corporate activity and also some softness in corporate sentiment, which has implications for PMIs going forward, which are so closely linked to earnings expectations and overall S&P performance.
And Nadia, what's your year-end price target for the S&P?
We are looking for 4,300, so we don't see a lot of upside left to this market from this stage, and we're not calling for any new highs over the next 12 months.
Is she saying we can take off the next 9 months?
I'm not sure that's what she's saying.
No, there's a lot to do, Tom, under the hood. There's still trades to be made. You know, it's not about going out and buying the broad market.
Trades to be made.
Get active, Tom, is
Maybe
what I keep
Twitter.
hearing.
Yeah.
The passive trader, the headline number. The reason I asked that, Nadia, because I knew the answer and I wanted to ask another question. I want to ask this. Is the reason it's 4,300, this idea that if we go above that, it's seen by this Federal Reserve as an unwarranted easing of financial conditions and they have to lean against it?
No. Our expectations are really driven by earnings. At the end of the day, it's the market follows earnings. So we have taken down our earnings expectations. We also think that valuation PE multiples have come in far enough. And we don't think that the Fed, even if we go above 4,300, I think that the Fed would get concerned if you're approaching 5,000 again. But we don't think that that's likely, just given the fact that economic activity is slowing.
Nadia, thank you, as always. Brilliant. Nadia Lovell there of UBS Global Wealth Management, 4,300, the price target year-end, Tom. A lot of work to do beneath the surface. Not the first time we've heard that.
Yeah, I mean, there we are, and we'll see what the data is, and also we'll see how the revenue dynamics of the companies are, given robust nominal GDP. Yeah, it's going to decline, John, but to where? On Twitter, John, this is not a small issue. This is Hart-Scott-Rodino and Peter Rodino, the giant from New Jersey who was involved in the Nixon impeachment. And he talked near the end of his life, Peter Rodino talked about how this was merger enforcement competition. What happens on this Friday after the jobs report? What do the attorneys for Mr. Musk tell him?
Clearly the strategy from Twitter, Tom, just following this, is just to keep playing by the rules.
Yeah,
keep playing by
absolutely.
the rules. Keep coming out with a series of disclosures and say, this hasn't happened, it was meant to happen. This hasn't happened, it was meant to happen. And Lisa, where we end up, does anyone think this deal is getting done? I mean, that's a question.
Honestly, given the fact that we've got a $40 share price, probably not. People don't seem to think so, given that you've got a discount of $14.20 baked into there versus the price that Elon Musk put out there. Whether it gets done or not, how much carnage has already been done to Twitter, given some of the departures, given some of the morale hit, given the fact that there is such great uncertainty as to the trajectory of the company.
Tesla down 4 or 5 percentage points. That's got to be where the story is for me. You've got one of the biggest auto manufacturers by market cap on the planet coming out and telling you they've got a super bad feeling, they want to pause hiring, and they maybe even want to cut the workforce by 10%. Tom, any other manufacturer, let's say it was Volkswagen, Daimler, Renault, take your pick. Any other manufacturer comes out and says that, it's headlines everywhere about a macroeconomic story. For some reason, Elon Musk of Tesla says it, and everyone's like,
Maybe not.
Really, what does that mean?
Maybe not Chairman Gensler, but I don't get it, John. I just simply don't get it. You're 100% correct. He plays by a different rule book, and it's simple. They've allowed him to.
But we respond to it as well, Tom, in a different way.
Yeah, okay.
In a very different way.
We're the media. I mean, where are the authorities on this to say you got to play by the same rule book as everybody else? Clearly, they're not evident.
Futures down 0.7 on the S&P, on the Nasdaq down about 1.1%. The jobs report 19 minutes away. You know the numbers. If you don't, and you're just tuning in, 318,000 is the median estimate in our Bloomberg survey. The previous number, 428K. Mike McKee with a big number in about 18 minutes.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. We're less than 20 minutes away from today's U.S. unemployment report, and it's likely to show the smallest gain in jobs since April of 2021. The median estimate in the Bloomberg survey says 318,000 jobs were added in May. Meanwhile, the report also may show a downshift in average hourly earnings growth. Tesla CEO Elon Musk reportedly has told executives the electric car maker needs to cut staff by about 10%. According to Reuters, Musk sent out an email titled, "Pause all hiring worldwide." The report says that Musk wrote that he had a, quote, super bad feeling about the economy. A 10% cut at Tesla would mean a loss of around 10,000 jobs. According to the UK's Defense Ministry, Russian forces now hold the initiative in Ukraine 100 days since Vladimir Putin launched the invasion. British officials say the Russians have gained momentum in their push to capture the Donbass region. They say the original Russian plan failed, but Moscow has since changed its goals and is now focused on the Donbass. And President Biden is pleading with Congress to toughen gun laws following a number of mass killings. In an evening address from the White House, the president called for a ban on assault weapons and high-capacity magazines. He acknowledged that lawmakers are unlikely to ban the weapons, so the president called for raising the age to buy them from 18 to 21. Bristol Myers Squibb has agreed to buy Turning Point Therapeutics, the developer of a lung cancer drug that is expected to launch next year. The all-cash deal is valued at $4.1 billion. Turning Point's shares more than doubled in pre-market trade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Fed, they'll just go straight to neutral. And then I think they're going to wait and see. They don't want to cause a recession. And that's why they're fine going to neutral. That's just taking their foot off the gas pedal a bit. But once they get to neutral and have to get into actual significant tightening, I think they're going to be a lot more cautious.
Megan Green there, the global chief economist at the Kroll Institute from New York City. We are 12 minutes away from your jobs report. Your data looks like this. Equities lower by 0.6% on the S&P, on the Nasdaq down a little more than 1%. Yields higher by almost a basis point. 291.68 on a 10-year. Crude 117.11, up 0.2%. Tom, you know the estimate well. Close to 320 is the estimate going into this jobs report.
We'll see that in 12 minutes here, folks. I'll be looking at the usual data, the strength of the economy. I know Lisa's looking at labor participation. Right now, participating with us, Randall Krosner. He's a former Fed governor and, of course, with Chicago Booth School, opening up their London shop and doing good work for Chicago from finance over to economics. Governor Krosner, thank you so much for joining today. I want to talk about this jobs report, the inflation that is clear, and what it means for a new middle class. Pew Research shows a shrinking of the middle class due to the success of prosperity in America. How flat on their back on this jobs report is the American middle class?
Well, there are a lot of opportunities for jobs right now. I mean, there are something like 2 job openings for every unemployed worker. That's really quite extraordinary. So there are a lot of opportunities out there. Have all the opportunities been taken advantage of? Is everything sort of equally spread? For sure not. But there's certainly a lot of opportunities there.
But 300,000 payrolls is not fully employed. That is a real job formation number. And I don't need a single point estimate. I know that's not your game. But do you assume in a fully employed America we go back to 175 or 200,000 non-farm payrolls?
Well, we'd probably go down from where we are. Remember, the unemployment rate is at near 40, 50-year lows. I mean, you're under 4%. We haven't had that many periods of sustained under 4% unemployment. But one of the issues that you raised is about people who are outside of the job markets, who are not counted as unemployed, that labor force participation ratio. That has not gone up as much, as high as it was pre-pandemic. A lot of that now is sort of older workers who would come back in, but for a variety of reasons, including health reasons, are a little wary of getting back into the market.
Randy, how do you look at the noise that we're seeing in the data? Because there is a narrative and there's a data point to back any narrative that you have right now. How do you look through it and get a leading indicator that gives you some sense of where the jobs number will go in June, in July?
Yeah, certainly when there's a lot of volatility and potential turning points in the economy, people can pick out different pieces of data and develop different narratives. And that just comes when it's when things are a bit volatile. So certainly in this jobs report, we're looking at both the unemployment rate, but certainly the number of jobs that are created, looking across the different sectors, looking at labor force participation, and also seeing what's going to happen to wages. That's a real wild card and something that the Fed focuses on a lot.
When we look at the participation rate that we've been talking about all morning, what are you expecting in terms of people coming back in? You were saying that there are a lot of people who cannot come back in for health reasons, for skills reasons. What does that mean in terms of the tightness?
So I think the labor market is pretty darn tight. As I said, we've got 2 job vacancies for every unemployed person. That's awfully high, and so. There are a lot of opportunities, but there's a lot of tightness that's there. But also, as you mentioned, there's a bit of a mismatch. So sometimes the job openings are there, but you just can't find people who have the skills in the right location for what the firms want.
Professor Krosner, let's channel the magnificent Alan Meltzer. We are in the middle of Jackson Hole planning, and Alan Meltzer once took me to task on the tundra of Jackson Hole by saying that we need to sum, we need to aggregate, we need to go macro. In this jobs economy, should we sum everybody together, or do you partition out parts of the American labor economy?
So I think certainly the Fed's point of view, they've got to look at the big macro picture. But as I was just discussing with Lisa, to try to look at what's going to happen, I think you have to pair it into some of the different pieces to see what's happening in hospitality and leisure, what's happening in some of these different sectors, to understand, well, is this really a supply constraint or a bit more of a demand constraint?
Why does it matter, Randy, if we have Jay Powell coming out and saying nuance doesn't matter here? At a certain point, even if it's supply side driven, can this be something that they let slide, given the fact that the only tool they have is to dampen demand, and they cannot allow inflation to remain at the level that it is?
Yes, I think I've said to you guys before, regardless of whether it's supply or demand, it's supply and demand coming together, and the Fed owns it. If inflation is high, people turn to the Fed and say, what's going on? You've got to do something about it. Jay can't simply say, oh, well, that's not my fault. I can't produce more chips. I can't drill more oil. That's not a good explanation. You can try to get away with that for 2 or 3 months and say that it's transitory, but after it's persisted for more than a year, it's their problem, and they have to worry about inflation expectations, regardless of what the source of the increase in reported inflation is.
Randy, are you prepared to call this a wage price spiral? Citi are there. Are you there?
So I think we're not there yet. We certainly are seeing elevated wage increases, but we're not seeing they have not on average exceeded inflation. Inflation's, depending on your favorite measure, somewhere between 8 or 9%, and wage growth has been more in the 4 to 6% range, again depending on your favorite measure. But that's pretty significant growth compared to where we were before. The real worry is that as inflation comes down, as I think it's likely to at some point, not anywhere close to the 2% target soon, but I think it's likely to come down. Are you going to continue to see wage demands in the 5% or so range if inflation is 4%? That can be a little bit tougher, and that's when you start to see a real change in the labor market. If real wages are going up very significantly, or people are demanding very high wage increases and demand is falling off, that's when you can get into a little bit of trouble.
If I'm a policymaker, my favorite measure is the lower one. Randy. You know how it works. Randy Krosner there of the University of Chicago Booth School is going to stick with us for reaction to the payrolls report, Tom, in about 2 minutes' time.
It's fascinating. I'm sorry, John. And Meltzer and I would argue about this constructively, and of course, always with homage to the great from UCLA and Carnegie Mellon. I don't know how you aggregate this American economy in a modern economy. Working with Krosner in Chicago was Gary Becker and Sherwin Rosen, and they said, look, we're different. We can improve. There's a part of an America, John, improving every week, and there's a part left behind. I don't know how you aggregate that.
Left behind and getting squeezed. And, Tom, that's been a problem for a long time. That predates the pandemic as well. It's been a big issue. Looking ahead to payrolls, here's your estimate, 320K. Lisa, is there a Goldilocks number for this market? A miss to the downside that perhaps we appreciate?
Is it the headline number that's going to be the Goldilocks number, or is it something underneath? And perhaps it has to do with wages coming in a little bit or not increasing as quickly, or the participation rate. Give us a number, and you'll get 5 different views on what that could mean for markets.
Mike McKee will give you a number in 4 minutes' time. Equity futures down 0.6% on the S&P. On the Nasdaq, down 1 full percentage point. The estimate is 320K. The previous number is 428. The official number is up next.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The jobs report in America 10 seconds away. The price action coming into it looks like this. Futures negative 0.7% on the S&P. On the Nasdaq 100 down 1 full percentage point. With your jobs report in America, here's Mike McKee.
Comes in much better than anticipated, John. 390,000 jobs were restored last month. The forecast had dropped to 318 after that ADP number. The change in private payrolls, even better, 333,000. Of course, both of those are down from last month. Last month, we'd seen 428,000 and 406,000 for private, but manufacturing payrolls come in up 18,000. Those numbers from the prior month down 22,000. We've had a revision lower. So it does look like the economy may be slowing down just a little bit. The unemployment rate stays at 3.6%. We had anticipated in the Bloomberg survey it would drop to 3.5%. In part, that may be because the labor participation rate didn't move all that much. It does tick up to 62.3, the expectation from 62.2. But we'll have to go underneath the numbers to get a better picture of what happened on the household side. Average hourly earnings, that's the big number everybody's watching, come in weaker than anticipated. 0.3% higher for the month, 5.2% on a year-over-year basis, which is down from 5.5%. Now, in this kind of upside-down world that we've seen, guys, this is probably good news for the Fed. The numbers are weaker than expected, but still strong. So they do show maybe signs of a decelerating economy and decelerating inflation pressures without suggesting that the economy is going to fall off a cliff.
This one won't settle any arguments. Let's push this through this market. Futures recover just a little bit, still negative 0.5% on the S&P. If you look at the bond market, yields with a lift by a couple of basis points at the front end to 265. Further along the curve, up by 3 or 4 basis points to 294. No major changes, TK, off the back of this one.
Well, they're not, but I'm going to do some math here, John, and I'm sorry, with a revision up in the last 60 days, John, we've created an average of 413,000 jobs per month. And I'm sorry, it's a job formation machine.
Neil Dutter of Renaissance Macro calling it Goldilocks-ish. Mike McKee, does that resonate with you?
Yeah, I think that's a fairly good way you could describe it, given the situation. This is only the beginning of what is supposed to be happening, but we've talked about this, and I know you guys have talked about it with some of your guests, the idea that because the markets have front-run the Fed a lot and have pushed rates up, you look at the whole yield curve, it's above where they think neutral is. Maybe we're seeing transmission a little bit more quickly into the economy, and that would be good news overall for the Fed. The biggest change that we have seen in terms of the employment data seems to be in leisure and hospitality, again, up by 84,000 for the month. Food and drinking places up by 46,000. Now, of course, we're getting into the summer season when there would be more people going into the leisure business. We'd see some of the amusement parks and things open up, so there'll be some seasonal questions about that. But professional and business services still are number 2 at 75,000 higher. That suggests that companies are maybe starting to take on some part-time workers or contract workers to see how it goes and if they need to continue. Transportation and warehousing adding 47,000 jobs. And that's a category that we've only really just begun to watch because of the shift from buying in person to buying online. Construction, 36,000. It had been unchanged in April. So the construction industry is still strong in the month of May, but we are seeing signs that that might be starting to roll over. So all in all, paints a picture similar to the beige book, that the economy is slowing a little bit, but but not falling off a cliff.
Mike McKee, thank you. Great work as always. Let's talk about the ish of the Goldilocks ish, Tom. You've got an upside surprise on a headline number, and to Mike's point, you go through this, the unemployment rate at 3.6%, it didn't drop any lower. You didn't see an upside surprise in wages. You have seen a tick higher in the participation rate. And when we spoke to Ellen Zettner of Morgan Stanley, I said, pick a number, any number, I can give it you now, which one would it be? She said the participation rate. Just a little bit of a lift there, Tom. It's not a massive move, it's not dramatic, but if you were sitting here and you were the Federal Reserve, what you'd like to see over a series of months was just for that supply side story to improve, Tom, without that inflationary experience being exacerbated by a much tighter labor market.
I'm going to give you no drama. I'll get it. Let me round it up here. You go from 292 to a 295 10-year yield. You're on your way back to that 3% number.
All of a sudden, with that, Tom, we've had a move of, I think, more than 20 basis points now on the week on a 10-year Treasury, put together with what would happen with a German 10-year Bund, which is up about 30 basis points. It's been a big week for yields.
Randall Krosner with us for some observations here, of course, with the Booth School of Chicago, the former Fed governor. Randy, I want to talk about what the Fed actually does around the table at the Eccles building with this report. Do they value an analysis of the inflation-adjusted wage? Does the real wage matter?
Sure it does, because they're looking both at the inflation to see where expectations are, what is happening in the labor market, and then they look at adjusting for inflation. Are real wages exploding? They're certainly not exploding. We've got inflation that's much higher than the roughly 5.5% growth of wages. And so I think, as you were saying, the Fed is going to take this as this is kind of what we were anticipating, that we're not seeing an explosion on the wage side. We're not seeing a collapse of the economy either. I mean, these are still very strong numbers. The unemployment rate at 3.6% is still an extremely strong number. It's very rare that the U.S. economy has a sustained unemployment rate below 4%. And so I think it's very much consistent with the Fed's forecasts. And so that means there's nothing that's going to stop them from continuing this march of 50 basis point increases. And as my former colleague from graduate school, Lael Brainerd, said, they're going to be marching through at least September in those 50 basis point rate increases.
Well, that's exactly where I wanted to go, Randy. Does this jobs report give credence to the idea that they could go 50 basis points, 3 meetings in a row, and then follow it on with another 50 basis point rate hike, even though last week some, including Raphael Bostic, were talking about a pause?
So I mean, as they always say, they're data dependent. We have to see how the data come. But if you get reports like this, is going to give Fed the confidence that they are doing the right thing, that they're starting to have a little bit of an impact on inflation. And hopefully once they get in the 2.5–3% range, they'll have more of an impact. Inflation expectations have not gotten out of control. The short-term expectations are super high, but that makes a lot of sense. But the intermediate to longer run expectations are really not much out of the range where they've been over the last decade. And this is why the Fed needs to act now. And this is why I think Lael was out there saying, we're going to be tough on inflation, because they have an opportunity. The opportunity is to raise those rates now when the unemployment rate is low, without inflation expectations getting out of control. As long as they stay well anchored, they can move into, let's say, around 3% or so. And then hopefully we'll start to see the inflation start to come down. And then they'll be sitting pretty, because they won't have to raise rates to those double-digit levels, which is where we were 40 years ago when inflation was this high.
Great to catch up, Randy, to get your thoughts on this. Randy Krosner there of the University of Chicago Booth School. The conclusion for him, the Fed has got more work to do. The story for us, equities not really changing off the back of this, down by 0.6% on the S&P, on the Nasdaq off by about 1 full percentage point, yields higher by 5 basis points to 295.89. Going to get a ton of input on the fixed income market in the next hour. We'll do that with Rick Reeder of BlackRock, Mike Collins of PGIM, Subhadra Japa of SocGen. TK, Looking forward to that on Bloomberg TV in around about 22 minutes.
Continue the discussion here, and I also want to note the real yield of 0.28% elevated, and look for John this afternoon on the real yield. Right now, joining us, Jeffrey Rosenberg with BlackRock. And Jeff, perfect time to talk to you. I want to know how the bond market responds to one of the themes we've seen, and maybe we see in this jobs report, which is we're going to move from 8% to 5% inflation or 4% inflation, and then there's a massive then what? How do you position in bonds given a bipart move in inflation and presumably in yield?
Yeah, and a week from now, we're going to have that conversation again with maybe a little bit more relevant information focused on, the CPI report. But the inflationary data that we get out of today, as you guys have covered, it's a little bit of, avoiding the worst case scenario. You get a little bit of improvement on the labor force participation rate. I would agree with whoever said that earlier. That's probably, for the inflation story, the biggest important number that we get out of the payroll report. Obviously, there's the average hourly earnings as well, and that avoided a negative disappointment in terms of fast print. I think the market this morning is maybe reacting on the headline. There's a pretty big drag to that headline number from retail. So if you discount that, this was actually a little bit stronger report. Perhaps that's what we're seeing in terms of the market. And as Randy just said, take a step back, 390,000. This is still a very, very strong and too strong labor market. So we need to see that slow. And, that's in the expectations. And you're getting a little bit of that, maybe a little bit of disappointment in terms of the slowing. I wouldn't read too much into it. And to your question, Tom, the jury is still out in terms of the inflationary trajectory. We're projecting it. Fair. We have expectations that we're going to see that decline. But you can't get the Fed really out of the business of focusing on the number one priority, which is getting inflation down, until you start to really see definitively that show up. And until that happens, it's going to be a very tough time to be thinking about, bonds in the portfolio as an equity hedge, bonds as, stable source of income and preservation of principal, because they've got to adjust. Now, the good news is there's been a lot of adjustments. So I think the pain that we've seen in the first quarter, unlikely to be repeated, but too early here on this report to say it's all clear.
As traders parse through the numbers, you are seeing a bit more of a lift to yields priced down on bonds, to your point, Jeff. And you're also seeing stocks get hit a little bit more, perhaps because it is still too hot for the Fed. I wonder, though, how much, Jeff, this market continues to be faith-based in terms of pick your data point, pick your narrative, confirm it, and move on. How much is that sort of what you're feeling right now?
Yeah, I mean, look, we all are going to have various interpretations on the data, and so will the Fed. But eventually, the data will show up, and it's not just one data point or two from which we extrapolate. And we have to be a little bit patient. We have to be a little bit patient to see that trajectory play out. The market may not be patient. One comment from Bostic, and everybody says, "Oh, it's okay." They're going to pause. And then Brainerd, tries to put that back in the bottle. So really, we got to focus not on, being sort of yanked around by various comments, but understand that the priority here is inflation. And that means a consecutive set of inflation prints monthly. So we've got to really follow this over the course of the summer into the fall before we can really definitively claim that the projections, the faith-based projections and the consensus expectations are actually being realized.
Jeff, it's a chart that we have tattooed to our brains, and certainly you do with all your work at Carnegie Mellon. The 10-year real yield, the inflation-adjusted 10-year yield, however you want to measure it, we're nowhere near back to normal, are we? What is your measurement of normal, given these uncertain times, that the real yield has to get back to?
Yeah, it's a great question, Tom, because it really is kind of the North Star for thinking about Fed policy. You know, the Fed wants to get back to neutral. You know, what is neutral? Well, first of all, neutral in real terms is a lot closer to zero, probably between 0.5%. But to get there, you need, you know, both an increase in nominal yields and a decrease in inflation. And if inflation doesn't do its part to decrease, then you need more increases in nominal yields. So when people kind of think about the 3% that the Fed's going to very quickly get to, you know, by the end of this year, early part of next year, the presumption there is that the inflation is also going to decline and do its part, and that's going to bring real yields back to something that's closer to neutral. So if you don't get that contribution from inflation, then you are going to need to see more on the nominal rate hikes to get closer to neutral. So there's two parts to that nominal rate forecast that's kind of embedded in bond prices, and a big part of that is a steady decline in the inflation rate.
Jeff, in about 2 hours, President Biden is going to come out and talk about how the strength of this labor market is going to allow the nation to navigate through a difficult period of time. He will talk about how it's one of the strongest labor markets in history. How do you look at that and then confirm the sort of bearish tilt of the market that's looking to recession, that's looking to a slowdown, and looking to an increase in the unemployment rate?
Well, it's about kind of setting expectations. I think some of the things we've seen from the administration is trying to get out ahead of labor market slowdown. But also slowdown here is a good thing. And that's a little bit tricky of a message for them to say, because it's all been about these great job numbers and how good that is. Now they've got to pivot to talk about the sustainability of the economy, and that too much of a good thing is actually a bad thing because of its impact on inflation. And so seeing this steady decline in payroll figures is actually something that we should look forward to and would be a good outcome. So I think it's kind of turning their narrative. It's what the market is looking for as well, and that's where this kind of bad news is good news in some sense, is in the market expectations.
Jeff Rosenberg, thank you so much. With BlackRock after this jobs report, it's a jobs report that still roils the markets. Here, I'm going to call the VIX out of stick, 25.59, with the NASDAQ down 1.5%. Dow Jones Industrial Average down 215 points, and SPX down 39, and some real movement in bonds. John and I were talking about 3% 10-year yield. You're almost there, 2.97% with a 6 basis point move. Oil with a 118 print, moving nicely. Dollar stronger, and I really want to point on a global basis into this Friday in America. Dollar yen now fully buttressed up against yen weakness. Lisa, the yen weakness of a 131 rounded up is tangible.
Yeah, the dollar strength highlighting this fear that the U.S. will be able to move well ahead of other central banks. I think it's notable when you take a look at the bond space, Tom, that you're seeing the longer end actually sell off more. Basically, that perhaps the Fed will look to some guidance from the fact that wages have not increased more and say we can hold off and allow inflation to pick up more on the back end. That is sort of the subtle message under the moves, Tom.
She just spoke with Elon Musk. We now speak with Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist. That was a joke, folks. Mr. Musk has had an eventful 24 hours. Gina Martin Adams, how do you and your team write equity with the buy part of a booming airline business and retail flat on their back, and there's 14 other sectors as well? How do you address that for Monday morning?
Well, I think what you want to really focus on is a few things impacting the equity market. First, the rates reaction to the employment market. The employment report is the most important thing that you want to watch. We are clearly in a market that is being led around by the bond market. Valuations have been responsible for the entirety of the S&P 500 correction so far, as earnings are still growing. That tells you a lot about what's really driving the equity market trend. But as far as the consumer, you allude to airlines versus retail. It's very normal at this stage of the cycle, frankly, as rates start to rise, for the consumer to transition to spending more on services and less on goods. The goods companies are under even greater pressure because that's where a lot of the operating margin weakness has emerged in the index over the course of the last few months. Nonetheless, as long as the consumer is still spending more on services, as long as the services companies are experiencing an acceleration in revenue growth, that does help to shelter the consumer space from what is a pretty difficult environment right now.
Gina, you say that it's been the bond market leading around equities, and that really has been a narrative out there and dominating a lot of the discussion. However, Credit Suisse's Jonathan Golub came out and pointed out that actually the fundamentals have also driven the narrative in terms of tech companies underperforming on earnings growth substantially year over year. How much is this actually a fundamental story of weakness in specific sectors, even with strength in others?
I think it's really a relative story, Lisa. Tech company earnings are still rising. They're just not rising at the pace that anyone had anticipated coming into this year. And that's the point that I'm trying to make when I talk about the bond market really driving the equity market. Yes, on the earnings lines, you have had negative revision momentum emerge over the last couple of months, and that's absolutely created further downdraft in the equity markets. But what's the sort of proximate cause of the sell-off is most certainly rates. I mean, if you look at long duration versus short duration stocks, we've seen this massive divergence in equity performance emerge because of rates. But yes, the economic situation is certainly driving some question into the earnings outlook. Most of it is emerging in the margin lines. Tech has been under pressure from rates, now is under pressure because we're questioning the long-term growth prospects for this space. But there's no evidence that earnings are contracting. And I think that that's an important point to make. Until revision momentum gets so negative that we actually see a contraction in earnings, the proximate cause of the equity market weakness is going to still be what's happening with rates. Maybe we transition to a point where growth is really the problem for the equity market, but we're just not there yet.
Gina, I talk about it, but you're the grizzled pro who's actually done this. Anticipate and guesstimate how rapidly corporations will cut expenses. What about this cycle? What about this time? Will they be out front and cut costs quickly?
They will, if and when it is necessary. It's just not become necessary yet for most industries. I think if you're going to see cost cutting occur, it's going to be in the goods-focused industries, most likely the retail space first, maybe some of the durable goods companies in the industrial space, where you'll see it, maybe some financials might start to see cost cutting, and then I would look for tech as well. But generally, companies are very quick to cut costs when necessary in anticipation of any margin weakness. Now, when we think about the grand landscape here, what we're seeing in the equity market is downward revisions to operating margin forecasts, and yet operating margins are still rising year over year as soon as the third quarter and going into the fourth quarter. At least that's what the forecast implies. If we see downward revision momentum to operating margins start to really pick away at that forecast, if we start to see the forecast for operating margins move into negative territory into third and fourth quarter, I think then you'll start to see companies really announce more cost cutting. But on the other side, you have to think about what creates that margin pressure. Two things have really created the margin pressure for companies so far this year. The first is China. The second is Russia, Ukraine. So if we do have a reopening of China and some resolution of supply chain constraints, that can ease the margin pressure materially. On the second point, Russia, Ukraine is still creating a lot of turmoil in the commodity complex. We still see commodity prices rising. So you could see a divergence in margin pressures emerge as China reopens, but the war in Ukraine is ongoing.
Gina Martin-Adams of Bloomberg Intelligence, thank you for your insights. And we move from the stock market to what's been leading the stock market around by its nose. If you listen to Gina Martin-Adams, that is the bond market, which brings us to Ira Jersey, Chief U.S. Rate Strategist at Bloomberg Intelligence. It appears that as traders look beneath the headlines, they see a more hawkish story for the Fed emerging, one where they'll have to act, and yet not enough to stave off more inflation over the long term. Is this just noise, or do you think that the market response after parsing through the data is important?
Yeah, I do think it's important, and the fact that we're actually outperforming, or I should say underperforming, yields are a bit higher than you would expect given the relatively modest payroll beat, because it's less than a 1 standard deviation beat, so we would expect somewhere more in a 4 or 5 basis point move in the 10-year yield, but 6 basis points is kind of right there. But I think, Lisa, when I look at this data and I look at aggregate labor income, so the number of people employed and plus the wage gains plus how many hours are worked, we actually are still growing that at over 9% year on year. And that means that you're going to have a sustainable kind of labor input push to inflation. And that's one of the reasons I think you have this reasonably decent sell-off since the number.
This is really important, folks, and this is why Ira Jersey is a thrill to have at Bloomberg. He goes to the absolute heart of the matter. Ira, let's state it again. It's so important. We're having all this bow tie Wall Street angst, and the fact is income is growing, right?
Yeah, that's exactly right. So people are focused on the wage gains slowing a little bit, and maybe that will keep the Fed from hiking quite as quickly. And they could be right in the longer term. But when you take the entire mosaic into account as to what's going on in the labor market, and the fact that you've had leisure and hospitality gains continue to ramp up, you had a 12% increase. So Angela Monolatos, my associate, noted that there's been a 12% increase in the wages just in leisure and hospitality, because people are going out again and things are reopening, and there's very tight labor markets for kind of that less skilled worker in those sectors, and that is going to be pushing wages up, and that's going to mean that spending in a lot of sectors is going to remain okay. So regardless of what equity and bond markets are doing in terms of their correlations, and they have been highly correlated over the last month or so, I think it's really, you're looking at a pretty good economy right now, and because of that, I think you are going to see the Federal Reserve hike 50 basis points, certainly the next two meetings, and probably in September too.
Do you have a tip point for bond instability as nominal GDP comes down? We had this complete fluke, double-digit nominal. We knew it had to end. And I guess it's coming down, but do you have a number on nominal GDP where things, not to be Lisa-like, but fall apart?
So not so much. I mean, what we're looking at quite a lot is really the illiquidity of the Treasury market at this point, because on June 15th we start to get the very first bonds that run off the Fed's portfolio. So as opposed to the economic situation where you have nominal GDP slowing, which is certainly the Fed's goal here in hiking interest rates and trying to get inflation down. Yeah. It's not the real growth story; it's a nominal growth story. But on the other side, you have a market that might not be able to kind of withstand some of the runoff that we're going to have. So you're going to see significantly higher volatility, I think, in rates markets. You've already seen it. Think about how many 10 basis point per day moves we've seen this year versus the last 10 years. It's been quite a lot. 7 basis points now out to a 298. We're on the 3% watch on the 10-year. Lisa, may we remind, the animal spirit of the American economy is published is 10.6% up. That Q1.
This is a really strong economy. And this is, I'm sitting here and I'm racking my brain to try to really dovetail the idea of the depression that a lot of people feel, and the sort of sense that there's going to be a downturn with the incredible momentum. And that is really the incredible argument that I see on Twitter and elsewhere among economists. How can you be talking about recession? How can you be talking about a Fed really torpedoing this dynamism, given the fact that this is an incredibly strong economy? Ira, do you get the sense that that is still likely, that there is going to have to be a measure taken by the Fed to create more weakness than people are expecting? Or do you think that perhaps the pessimism has gone too far?
Well, I do think that the Fed has to push us into recession. The only way for us to get a significant slowdown in inflation and these price pressures is to reduce demand, because a lot of what's going on in the economy right now, and one of the reasons for some of the higher prices, has started with supply chains, and we all know the narrative. We've been talking about it for a better part of a year now. But it really is that the Federal Reserve has to push us into a recession, at least in terms of real growth. But like Tom was implying before, and I completely agree with this, is that we really need to get nominal growth down. So it doesn't mean that we have to have a very deep recession, right? But we do have to have growth slowing on a real basis in order to get nominal growth much lower and for inflation to come down to more reasonable levels. And it's going to take years. Like we don't appreciate this, but we're still going to have 3+% inflation through 2023. And that's not an environment where the Fed is likely to be cutting interest rates, even though Bullard and some others think that they might be.
Brilliant. Ira Jersey, thank you so much. What a primer with Bloomberg Intelligence this morning. Lisa, I can't say this enough, and I can't wait for Michael Darda to publish off of this report today with MKM Partners. To me, the heart of the matter, witness American Airlines today, and I understand Lisa, you got to get on a plane this weekend and fly down to Atlanta to sit in the airport for the weekend because of thunderstorms. But the answer, Lisa, is it's a boom economy. And as Jersey just said, the solution is the x-axis gets extended out far more than the tantrums of the media.
I like your hand motions. It's really good on radio.
It works great on radio.
What Ira was saying, though, is we could still have a boom economy on a nominal level, but on a real level, we need to see it decline. This is important, right? Because people are spending more money because they have more money. This is just math, right? I mean, when you see inflation, people are earning more, things cost more, then there is more money in the system. At what point does growth slow substantially enough to stop the pace of price increases? And that, I think, is really a hard message to create in a world that does not deal with nuance very well.
Futures deteriorate, -42, Dow futures -232, and the VIX out of stick, 25.64. We are on the 3% watch and the 10-year yield. That will be, is it something that Marty Walsh wants to talk about? I don't think so, but probably Farrow will cram it in there if we get a 3% print on a 10-year. John Farrow with the Secretary of Labor. Look for that coming up on radio, on television. This is Bloomberg.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the data providing something for everyone.
This jobs report.
Even if we see those headline numbers roll over,
the labor market is too tight.
This is where we've seen the overheating of the U.S. economy happening.
It is inviting the Fed to tighten policy substantially.
This is where obviously the Fed tries to slow down things.
They do need the labor market to cool.
It is generating inflationary pressure.
The Fed needs to loosen that up, or wage pressures will accumulate.
There's still not signs of significant slowdown in the labor market.
A cool-off in the labor market would be a good thing.
You're trying to guide unemployment up.
The data will give the Fed wiggle room.
It just takes Fed rate hikes quarters to impact the economy.
We're in a difficult situation.
But unfortunately, when the world's uncertain, we just have to admit it.
With your jobs report, let's get to Mike McKee. Morning, Mike.
Good morning, John. Good news for Jay Powell. He's got to love these numbers. It suggests the economy is slowing down without going into any kind of recession yet. 390,000 jobs were restored during the month of May, and we lost 22,000 in revisions. So it is a little bit better than we anticipated, and that's good news for the Federal Reserve. Unemployment rate stays at 3.6%. That's also good news because they're supposed to be pushing up unemployment. Unemployment did not rise, but it didn't fall either. The participation rate is up a tick at 62.3. Average hourly earnings fall a little bit. They were up only 0.3 for the month, so that puts it at 5.2% for the year. And that is also a sign of maybe slowing inflation pressure. You can see the categories that mattered. Leisure and hospitality still adding back jobs. Professional and business services, maybe people are hiring contract workers right now. Retail, the big loser, down almost 61,000 jobs, but that was offset by transport and warehousing, 47,000. That's a category that shows up when Amazon hires a lot of people for warehouses, et cetera. So it could be a shift in the mix of employment in the retail kind of category. So that leaves us now with this question: where do we go with inflation when unemployment is staying steady and not rising? You can see there that it has been pushing the inflation rate, the PCE inflation rate, up by with the higher earnings. And now if that falls off, John, things could be a little bit better. You used the term Goldilocks earlier. Maybe Jay Powell is Papa Bear here.
Mike McKee, thank you, buddy. I'll leave that one. I'm not going to use that term. Mike, wonderful work as always. Yields are higher on a 10-year by, let's call it 7 basis points to 298. In the equity market, we're lower by about 1 full percentage point. I didn't use the Goldilocks term. I used Goldilocks-ish, and that wasn't mine. That belonged to Neil Dutter of Renmac. He went on to say the following. The unemployment rate was flat. Average early earnings were flat relative to the month prior. The participation rate ticked up. Good news for those expecting the Fed to back off at some point. Do you share this view? Let's get to BlackRock's Rick Reeder for more. Rick, do you share that view? Would you call this Goldilocks-ish?
I don't know. I'm not sure about the Goldilocks-ish. Listen, I think this is a really big report. Quite frankly, I think this is the last solid report you're going to get for a long time. If you look, and I think what Mike McKee just said, I think was pretty interesting, but if you look at what the trend is, I look at these high-frequency cyclical indicators, retail obviously being soft, but leisure and hospitality, business services, the trend is coming down. I mean, when you obviously hear from Elon Musk, you hear from Amazon, you hear from the big tech companies, the trend is definitely decelerating. We have made the turn on employment, and I think today was the last. When you look at the top line headline number, that was solid, because it takes a bit of time to transition. Things like education are still strong and will stay pretty strong. Listen, the levels are pretty good. The Fed, this will do nothing to deter the Fed from where they're going. But I think it's a big report, because I think we're now going to make the turn. I think the next 3 or 4 months, you're going to see these numbers decline. I could see a negative print over the next 3 or 4 months, and that's the thing that I'm keyed into. And I think that's what markets will react to and try to interpret how deep the Fed's going to go in bringing employment down, bringing the demand function down through the employment channel. And I think that's going to be a big deal for markets.
Hey, Rick, this is a big call. You think this is the last good one? Over the next 3 months, we could get a negative print. What's leading you in that direction? Why do you think that?
Boy, I did it in one of our strategy meetings. I read all the companies. I mean, it is a lot. I don't have it in front of me. It's a long list of companies that are freezing hiring and or cutting staff. And it is a persistent across big tech, across some of the rapid areas that you've been seeing, healthcare. You're starting to see, and by the way, then the correlated issue to that is you're seeing restaurants. I mean, I follow the restaurant sector pretty closely, and you're seeing that all of a sudden, boy, you couldn't offer delivery before, now you can, and now the availability of labor is really improving. I mean, almost across every sector, you're hearing companies talk about we can now hire, some of the very specialized skill areas are still going to be hard. Biotech's hard. But boy, you're seeing availability of labor. There's no question in my mind we're making a turn. And the question is how deep it is. And then, quite frankly, how much the Fed is going to lean into this to try and bring down inflation. And I think that's going to be the critical thing for markets.
And so, Rick, that's the economic analysis. That's your opinion, your view, made up by what you've been reading. Push it through this market. Yields are higher today, equities are lower. What are you doing?
So, I'm in the same camp that I've been in. Well, actually, I would say changed a little bit. And, we've been talking about for a number of months. Cash is a good asset. And I think, listen, rates have got to go a bit higher. There's something, though, you've priced in now on the front end of the yield curve. Almost, you've priced in 50 basis point hikes for the next meeting, 50 basis points for July, and then 50 basis points for September. Pretty close to 50 basis points for September. Listen, the market's pricing in a fair amount on the front end of the curve. I still think rates can move a bit higher. I think the 10-year is going at 3, 3.25. So I think we've got a bit of room to go. So we're keeping our interest rate exposure moderate relative to that. But, for the first time, Jonathan, since the last, probably this year, last few months, we've been talking about this. You have to think about the Fed's tightening financial conditions. That is the title of the book. And the conclusion of the book will be they will have done that. The chapters are interesting in between, but that's where we're going. But for the first time, you're getting yields back far enough in some of the credit sectors. So we started to add some high yield. I know I've been talking negatively, or we didn't like high yield for a while. We're starting to add some pieces. We have been. And so, but I think you can be slow. I think you can be deliberate. I think you're still going to see rates move a bit higher. And listen, the title of the book is Financial Conditions Are Going to Be Tighter. And that's how the Fed, one of the channels the Fed's going to use to reduce demand and bring down inflation.
So, Rick, as you position in high yield, just a little bit, I don't want to overemphasize what you've just said, but if you do that, are you basically telling me you can't expect too much spread tightening from here Because if you do, that's an unwarranted easing of financial conditions because this Fed doesn't want them there?
I couldn't have said it better than you did. I think, listen, I think that's right. I think you're going to hear, as you get, employment data be a bit softer. By the way, you look at net disposable income, you're seeing the wages component, certainly the rate of growth slow. And then you think about what is the true consumption that individuals, it's, gosh, I've got higher gas prices ahead of me. I've got higher food prices. I've got higher rental rates. So net disposable income is coming down. Consumption is going to slow. So people are going to say, gosh, we're going into a recession. I actually don't think the U.S. is going into a recession. I think Europe is sliding deeper into slower growth. China's obviously in slow growth. So I think you're going to have to be careful about high yield because people will get worried about that. Listen, I don't think we're going to a recession because the starting point on all these things is really strong. I mean, the employment numbers are going to slow down, but gosh, if you said 390,000 employment top line payroll 3 or 4 years ago, you'd say, wow, the economy's strong. It's just we're decelerating. I don't think we're going to a recession, but I think people worry about that. Markets will worry about that over the coming weeks and months.
Where does this leave equities, Rick, for you?
I think they're okay. I don't think they're. I mean, I think they're. I still think they need to back up a bit more. Listen, I don't think when you do. I always value equities based on what is your cash flow relative to your cost to finance it. That means where are the credit markets, where are yields, and if yields still have some upward drift, if credit is still maybe got some upward drift, I don't think equities can make a significant upturn yet. But, are there, by the way, there's some areas, we've started to pick away on some of these areas that I think have come under a lot of pressure under the cyclical framework is coming out as being softer. So I still think equities, I'd rather, quite frankly, start buying yielding assets into the portfolio before taking a lot of equity beta risk. The one place, Jonathan, that I think is really interesting, I know I talked about, I think Jamie Dimon's the same thing about we're in this hurricane of financial conditions. People buy a lot of insurance during hurricane. I like selling during hurricanes. I like selling volatility, selling some downside on equities as opposed to taking a lot of, gosh, I want to take a lot of equity to what we call Delta 1 or beta risk today. So a bit more moderate, but sell the downside. If people want to buy insurance on we're going down 15% in equities, I'd rather sell that.
You mentioned you did like a place in the equity market. Rick, you didn't name it. Where is it?
Okay. So, the place that I think has gotten overdone, there are a couple places I think have gotten overdone. I mean, and by the way, had a huge run yesterday, was like software. I mean, some of these companies that, and we saw some earnings reports from Salesforce.com, Dynatrace, et cetera. Gosh, these companies are cash flowing really well. The multiples have come down to levels that are, are not, if you're growing 30% organic top line growth, forward multiples of 2025 are not for those types of growth engines. So I think that's interesting. Again, I think you got to be a little bit careful because people worry about recession, so you don't go all in. I think some of the autos globally have become pretty interesting. Listen, I still think energy, there's not enough. The inventory levels of energy in this country are still too low. So I still think energy is in decent shape. So it's still a good hold. And I think some of the industrials have gotten overdone a bit. But those are the places. Listen, I think tech. It's been like get out of tech because we're cyclical in rates. And by the way, today could be a good day. People worry about rates moving much higher. And then, so I think some of those areas are worth. Again, I don't think it's worth going all in yet.
Rick,
and by the way, it's in the same framework of where do you sell the downside? If people want to pay huge levels of volatility to sell you 15-20% down from these levels, that's a pretty good place to get into some of these names, or at least get some fee into the portfolios.
This is a super nuanced view from you, Rick, and I appreciate it. Thanks for your time, buddy. As always, Rick Reeder there of BlackRock, just breaking down the equity market, the bond market from his perspective, where things are going. Where things are going right now, equities lower by more than 1% on the S&P with your movers going into the opening bow. Let's get to Abby.
John, well, front and center to this morning's bearish tone, of course, the shares of Tesla down sharply. This as Elon Musk, CEO, of course, of that company, suggests that Tesla may need to cut staff by 10%. That would equal almost 10,000 workers. This in an email seen by Reuters titled, "Pause all hiring worldwide." Elon Musk in the email says he has a, quote, super super bad feeling about the economy. So really in agreement with Jamie Dimon of JP Morgan and really in line with what Rick Reeder was just talking about too. Now, relative to Rick talking about Apple, or tech, I should say, overall being relatively on sale today, well, there you have it. Apple down 2.6%. This, of course, as yields are backing up from that jobs report. Alphabet also down 1.1%. And software, Rick was just talking about software. Take a look at Asana, down more than 8%. This is a collaboration software company. They beat in the last quarter, but their guidance for the future quarter not great. Analysts concerned about margins and a big cash burn. There is a 27% bearish short there. Interesting though, John, you do some work on it. Maybe there is some sort of something interesting to look at there on the shares of Asana, but overall bearish open here.
Abby, thank you. Coming up on this program, warnings from the C-suite piling up.
This is among, if not the most complex dynamic environment I've ever seen in my career. The confluence of the number of shocks to the system, to me, is unprecedented.
From JP Morgan to Goldman and now to Elon Musk of Tesla, that conversation up next.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy. You better brace yourself.
We certainly expected that we would have a tougher economic period ahead of us. There's no question that we're seeing a tougher capital markets environment.
The warnings piling up. Tesla, the latest. The CEO, Elon Musk, in an internal email, according to Reuters, saying the following. He has a super bad feeling about the economy. A super bad feeling, Katie Lyons.
Super bad. I don't know what the difference is between super bad and just a bad feeling, but either way, that is what Elon Musk is using to justify his desire to freeze all hiring and cut 10% of Tesla's workforce. And of course, John, we would care if it was Tesla alone, because it's Tesla, a huge heavyweight in this market. But the fact of the matter is, Tesla is far from alone. We have seen a laundry list of companies, many of them in the tech sector, making similar announcements about their workforces. Snap, Microsoft, Apple, Instacart, Lyft, all slowing hiring for different groups. Meta cutting freezing hiring for some teams. Coinbase is freezing hiring. Twitter has as well, while PayPal, Robinhood, and Netflix have outright cut jobs. Apparently, Elon Musk also wants to do that now. And all of that added to warnings of a different kind, including foreign exchange rates, which is what we heard from Microsoft yesterday, cutting its guidance for the current period because of a stronger dollar. And of course, all these companies have in common, John, that they are technology companies, those that have been pressured the most by investors so far this year, with the NASDAQ 100 dramatically underperforming that of the S&P 500. Now, for all of that fear, it really is going to come down to the fundamental picture. And the fact of the matter is we are seeing margins hanging in there. In fact, 14.1% margin for the S&P 500 is what estimates are for 2023, but we are starting to see those come down. According to Bloomberg Intelligence, since April 22nd, S&P margin estimates have dropped 36 percentage points for the second quarter, 19 percentage points for the third quarter, and 7 percentage points for the final 3 months of the year. And our Bloomberg Intelligence senior equity strategist Gina Martin-Adams says that's probably going to get worse, not better, as these companies face higher costs, including higher wages, which helps explain why some companies are looking to pay less people at all, John.
Katie, thank you. How's this for value add? Do you remember the movie Superbad? Just had a terminal subscriber who messaged me and said that McLovin was born on June 3rd.
That can't be a coincidence.
Just in case you're wondering. I'm not saying anything's going on here, just saying. Katie, thank you. With us now, SocGen Subhadra Rajappa, PGIM's Mike Collins. Subhadra, based on the data, have you got a super bad feeling about this economy?
Not yet, but it's a tale of two halves, right? Like the first half of the year is relatively strong. We've seen pretty strong job growth. ISMs are very strong. The question is, what does the second half hold for us? And really, that's where the concerns are, mostly in the bond market as well as in the equity market, which is, are we going to see a meaningful slowdown in the pace of job creation, if anything? Is this going to lead to a slowdown in growth, as well as, a slowdown in the retail sector? The consumers are under a lot of pressure. So that's really what we're focused on here going forward, is sort of looking ahead. What is the data going to show us? And that's really where most of the concerns are in the bond market.
Mike Collins, your take, please.
Yeah, so this is how it works, right, Jonathan? The Fed signals that they want to tighten financial conditions. Sure enough, financial conditions tighten, and they've tightened a lot already, even though the Fed's barely started hiking and just started quantitative tightening. It feeds through asset prices, where we've seen some pretty significant devaluations, and I still believe in private debt markets, real estate markets. You haven't seen yet the asset price hit there. And then it feeds through to consumer and business confidence, right? And I think you're just at the beginning stages, and you're seeing all these CEOs, their confidence is waning, right? There's a little less certainty about the future. So they pull back on big projects. They pull back on big hiring. They put on hiring freezes. And this is how the cycle plays out. So I think you're just going through this moderation phase in the cycle. And I still have a pretty high conviction that our softish landing is going to be realized.
And 10 minutes out from the open, equities lower by about 1% on the S&P, down 1.14% on the NASDAQ. Subhadra, this move in yield is interesting. Looking at 3% again, 297 up 6 basis points on the day. Subhadra, last time we spoke, we talked about that 320 level on 10s you were looking for, that 120 level on German 10s you were looking for. German 10s pushing almost to 130 this morning. Your thoughts on what's happening here as yields start to break out just a little bit once again?
Well, the market participants are really pushing back on ECB's gradualism, right? You're seeing very, very strong inflation prints in Europe, and it's call to action for the ECB. They're still saying that they're going to be raising rates at 25 basis points, a meeting starting in July, and that sort of gradualism might just not work for them. And the real concern for the ECB is that they're going to fall behind the curve, especially with aggressive rate hikes coming from the U.S. I think the longer they wait to raise rates, the harder it's going to be for them to be able to raise rates. And that's exactly what the market's kind of pushing them towards, is to act sooner and faster.
Mike, you've got this dual tightening of the Federal Reserve, an ECB that's ready to go, maybe next week, using that opportunity to lay the groundwork for July. A lot of these bullish calls in the equity market, they hinge on a Fed pausing in September. They hinge on this idea that we've seen peak inflation, we've seen peak yields. In Europe, that might not be the case. How important is that to you, Mike?
I think it's really important, right? But there are a lot of these hikes now priced in. And I think for the ECB, Jonathan, this is like a get out of negative interest rate jail card, right? So they're taking this opportunity to get that deposit rate from negative territory back to positive. But I don't think it's a big tightening cycle in Europe. But there's a lot of tightening priced in. In the US, right, the funds rate that's priced in, the terminal funds rate has been between 2 3/4 a few weeks ago, all the way up to about 340 about a month ago. So right now it's right in the middle, about 310. So the game that the markets are playing is where does it shake out? It's a pretty narrow range, and the markets feel like they're pretty fairly valued for this 3-ish terminal funds rate. So I don't think there's a lot of risk for a big move higher in bond yields from here.
Mike Collins, Sabatra Rajappa will be sticking with us. We'll catch up with the White House first on this program in about 8 minutes' time. Then we'll get the reaction of Mike Collins and Sabatra Rajappa to that. It's like the last 8 or 10 years in reverse. Central banks have gone from wanting lower interest rates to lower inflation and a weaker currency to wanting higher interest rates, inflation lower. In fact, inflation higher was the previous 10 years. You get where I'm going with this. And a currency that they now want to be weaker, stronger. Can you keep up with any of this? We're down about 1% on the S&P. From New York, this is Bloomberg.
at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes until the opening bell. Equities lower 1%. Here are your morning calls. First up, Piper Sandler downgrading Micron to underweight, highlighting the chip maker's oversight exposure to consumers and macroeconomic trends. Your next call from Goldman, downgrading Travelers to South, 170 price target, seeing little upside with margins starting to weaken. And finally, Cowen trimming its Q2 delivery estimates for Tesla, expecting China's COVID-0 policy to weigh on production numbers. Since I butchered that moments ago, the last 10 years in reverse, we've gone from wanting rates lower to wanting rates higher, inflation higher, now lower, and a currency then, everyone wanted a weaker one, now they want a stronger one. I wish we could edit a live program, but we can't. Coming up, Secretary Walsh from the White House on the latest jobs report. Reaction coming up next from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell this morning. Good morning to you all. Equity futures just negative by more than 1% now on the S&P. On the Nasdaq 100 by 1.6. Coming through to Friday, through the close on Thursday, we're actually positive on the week, set for a second week of gains. Right now, not so much. Let's the opening bell, switch on the board and get to the bond market. Yields creeping a bit higher post payrolls, approaching 3% again. We came close, up 5 basis points now to 296. In the FX market, euro dollar 107.30. We're negative there, 0.2%. And crude just creeping higher. Remember the high of the week, 119.98. Right now, 117, up 0.25%. That's the cross-asset price action with your movers. Here's Abby.
John, let's start out with this morning's top stock. And that, of course, is Tesla shares lower. This, of course, is Elon Musk has that super bad feeling about the economy. In an email seen by Reuters titled "Pause All Hiring Worldwide," he, of course, suggests that the company may have to cut staff by about 10%. That would equal nearly 10,000 workers. So it seems Elon Musk, of course, is in agreement with Jamie Dimon, John Waldron, even Larry Fink about the possibility of the economy really taking a sharp downturn. Now, tech is down also with Tesla. Microsoft yesterday getting a pass for that guide down for the current quarter on FX, but maybe it's more on this weak economy. This weak macro down 1.6%, Apple down 2.8%. Yields higher on that decent jobs report. That, of course, pressures the high valuation tech stocks. And rising yields not even helping out the banks, John. The story of this year, J.P. Morgan down 0.6%, even as yields back up. So a bearish Friday for the week. Let's see whether or not we do get gains on the week.
Abby, thank you. We've got to move to tech as well. There's one man charged with following Elon Musk here on Bloomberg TV. It's Ed Ludlow on the West Coast. And being on the West Coast, Ed, given that Elon stays up sometimes and sends out emails and tweets, you don't get much rest, do you?
I'm smiling, but inside it's a very different feeling,
it's
John.
painful,
Look. Painful. Two companies, two stocks moving in different directions. Elon Musk at the heart of them. Let's just get Twitter out of the way, right? Twitter up 1.6%. The Hart-Scott-Rodino period, it's a regulatory rubber stamping. Twitter has put out a regulatory filing saying that period has passed. Either it means that the set term that was agreed between the parties has passed, or regulators have said to Twitter and the Musk coalition, you are free to proceed with talking about the deal. The stock's higher by almost 2%. We're moving towards a place where we think it's happening. Tesla is the focus, down 5 percentage points on Tesla. I'll remind the audience that the idea around economic uncertainty and recession with Elon Musk is not new. 7 days ago, he replied to a Twitter user, of course, saying that he foresaw a recession that would last 12 to 18 months, but that in his opinion, that was no bad thing because it would basically eliminate cash-poor companies that weren't going anywhere and the stronger ones would survive. He also used that as the first reference to basically talk about how people needed to work harder and get back into the office, and we know what happened after that. The memo seen by Reuters, which was sent to executive staff, says that they will pause hiring and cut jobs by 10%, John.
What do you make of the idea that June 3rd McLovin was born and that was super bad? Ed, what do you make of that? Is something ridiculous going on here that we just don't know about?
Hard inference to pull, John. I think that...
I never thought I'd be doing this on business TV, but here we are, Ed, doing it.
We are. I mean, at the end of the day, Tom Keane just asked me on radio, how seriously do we take the tweets versus the internal memos versus the regulatory filings? At the end of the day, it's the CEO of a massively publicly traded company across 3 continents. You have to pay attention.
Ed Ludlow, thank you. We're paying attention. The stock is down by 4.5%, about 3 minutes into the session. Equities are doing pretty badly too, down 0.9% on the S&P 500, on the Nasdaq 100 off by 1.5%. On the Russell, the small caps, negative 0.72. From New York City, I'm pleased to say on Bloomberg TV and on Bloomberg Radio, we're joined now by the US Labour Secretary, Marty Walsh. Secretary Walsh, first of all, sir, I know you've been unwell the last couple of days. Can you tell us if you're okay?
I'm doing all right. Yeah, I feel a lot better. It's thank God I'm vaxxed and boosted, because this thing, it attacks your immune system, but I feel good, so thank you for that.
Well, you're a good man for giving us some of your time. I've agreed to shorten up the interview just so you don't have to do much today. So let's start with this one here. The jobs report, your assessment, sir, the view from the White House at the moment.
Certainly, it's a good jobs report, 390,000 jobs. We're seeing good gains there. One thing that we looked at from when the president took over, we had 10 million people out of work in America. It's down to 455,000. That's a good number. We're seeing steady and stable growth here in the jobs reports. But we know, as I say every month, we have more work to do. This what outpaced what the expectations were, but certainly we know there's work to do. We know we're still dealing with inflation. We're still dealing with an economy that people are concerned about, and the president's laid out a plan for it.
You know the numbers well. 1.9 jobs for every unemployed person in America right now. The quits rate is elevated. That's a sign of confidence. The unemployment rate didn't move lower today, but still a decent level of 3.6%. Yeah. The worker, most people are concluding, has a fair bit of bargaining power here. So, Secretary Walsh, with that in mind, what kind of approach would you like to see in the talks with unions representing the workers on the ports on the West Coast? We talked about this a few times over the last few months. What's your view now?
Yeah, I think that those conversations are going steady. I've been staying in contact with the folks out on the West Coast. Right now, I think it's on a good pace, and they just need to continue to have those negotiations. Obviously, anytime you have a negotiation like the ports, whether it's on the West or East Coast, but in this case on the West Coast, we want to keep a close eye, because we know the impacts that if it doesn't go well, what it'll have. But I feel pretty good I feel confident where they're headed on those conversations.
Can you give us some idea of why you're confident based on the conversations of the last month, what the developments actually are, specifically?
Yeah, I've spoken to both the companies and the unions, and neither one have really said that there's any obstacles that they're really concerned about right now. What they're doing is they're having the negotiations that they have every few years, and and certainly I think all the parties know what the American people have gone through over the last couple of years with supply chain issues and what's happened in the port. So I think they also understand the importance of getting a contract done.
Secretary Walsh, just finally, because I know you have to run, we've had some warnings this week from some big players. Jamie Dimon talked about a hurricane coming to the economy. We heard from Elon Musk of Tesla. Reuters reporting that he sent an internal email pausing hiring, potentially cutting 10% of the workforce. Are you seeing much more of that in the conversations you have with corporations week to week, day to day?
No, they haven't really brought that up to me, but I'll tell you, the president has been very, very focused on making sure that we continue to tackle all the inflationary challenges and the challenge of the economy. I mean, this is an all hands on deck approach that includes government and corporations working collectively together. I think that we're kind of like, we're in a marathon here. This isn't a sprint, this is a marathon, and we have to just continue to move forward one day at a time.
Secretary Walsh, we appreciate your time, and I hope you get better soon. And we'll get you back in person, hopefully. Thank you, sir. Thank you very much. Secretary Marty Walsh there. From New York, let's get back to this market as well and bring in two special guests. We can catch up with Subhadra Rajappa and Mike Collins. Subhadra, I want to come to you first. The warnings we're hearing from some big players in the C-suite. I want to understand from you where you think this labour market is going, based on something we heard from Rick Reeder of BlackRock earlier. Let me play the sound, and then I'll get your reaction.
This is the last solid report you're going to get for a long time. The next 3 or 4 months, you're going to see these numbers decline, and the employment numbers are going to slow down. But gosh, if you said 390,000 employment top line payroll 3 or 4 years ago, you'd say, wow, the economy's strong. It's just we're decelerating I don't think we're going to a recession, but I think people worry about that. Markets will worry about that over the coming weeks and months.
So, Badra, your thoughts, please.
Well, I think that the pace of job creation has to decline, right? You're looking at a very, very robust pace of job creation all through the first half of this year. So that pace has to slow down. The question is whether we go into negative territory, we start losing jobs at some point. And that might actually be what the Fed ultimately, I shouldn't say desires, but that might ultimately what happened because of Fed policy actions. The Fed's going to be aggressively raising rates by, say, 50 basis points a meeting for the next few meetings. And this jobs report is basically the green signal that they're looking for to continue to tighten policy. So the side effect of that is going to be that you're going to see a slowdown in the pace of job creation, perhaps layoffs, and perhaps a much, sort of less tighter job market than you're currently seeing right now. Job openings are going to come down, and the unemployment rate is going to probably, edge up a little bit. But broadly speaking, I think that the labor market is still going to remain very strong. And that's the one part of the economy that I think is going to hold up quite well for the remainder of the year.
Mike Collins, your take.
Yeah, John, as we all know, the labor market's been surprisingly rock solid, but it is decelerating. That pace of gains is decelerating. I don't think it's a function of the economy slowing as much as just running out of workers, right? We're getting back to full employment for sure. So that's really good news. This cycle's kind of moving along at a really accelerated pace, which is as expected, but things change quickly, right? I mean, my youngest daughter just graduated college. Actually, her birthday is today also, the same day as McLovin. I did not know that, so thanks for sharing that. 2 months ago, I told her, you are graduating into the strongest job market of your life. And already now, 2 months later, I'm worried that in 2 months from now, she might have trouble getting a job, right? So the markets change, sentiment changes. So I am worried that things slow more quickly than we think.
I wasn't planning to talk about Superbad the movie today. Mike, just to give you the opportunity, would you like to wish them a happy birthday?
Yeah, Nikki, happy birthday, baby.
Do you want to wish McLovin a happy birthday? No, we don't have to do that either. Don't worry. Mike Collins, you're going to stick with us alongside Badra Jaffer. Coming up, OPEC garnering signs of relief with a boost in oil supply.
We welcome the important decision that OPEC Plus made to increase supply. The United States will continue to use all tools at our disposal to address energy prices.
That conversation up next, and a happy birthday to Nikki.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.